Mm. Financial statement analysis in level 2 is not the same as level 1. In level 1, you perhaps had a situation where FSA was just introduced to you. So majority of the topics were very basics like income statement, balance sheet, cash flow statement. Those were very basic topics, honestly. Right now, I know when you started level 1 FSA sounded like nightmare because it was too lengthy. Ironically, level 2 FSA is very less correlated with level 1 FSA. Level 2 FSA, in fact, has very few things from level 1 FSA. However, what you studied in level 1 will definitely help you in level 2. Okay. Some of the aspects are similar, as very few, in fact, I should say, very few aspects are similar. Otherwise, it's an altogether a new thing. Here, FSA has a sizable weight around 10 to 15 percentage, like many other topics. So you can expect around 2 to 3 vignettes or around 8 to 12 questions in exams, right? And there are around 6 readings as of now. Now, out of these 6 readings, the first 3 readings are lengthy, giant. So I'm going to do step by step cover everything. But all of the readings are very important from the exam, especially the first 3 readings. Okay. So let us start with the first reading itself. We are now starting with intercorporate investments. Now, as the word says, what is intercorporate investments means when my company invests in other companies in the form of debt or equity, right? So when you buy a stake in other company, that is what the discussion will be. Now, that's a part of your investments, isn't it? So you do an investment in another company, that's a non-current asset. I'll repeat, that's a non-current asset. But depending on how much control or how much stake you have invested, there are broadly 4 categories of these investments. Okay. So what is intercorporate investments? It is investment. Intercorporate investment is investment in marketable securities. Securities means either in the form of debt or equity, right? And this can be categorized either as a financial asset. Financial asset, why? Because you are investing in another company, or investment in associate second, or third, a business combination. In fact, not three, but there are 4 categories of investment that we are going to see, but those depend on how much is your ownership. Now, when I say ownership is percentage of shares that you hold, but along with percentage of shares, which is the voting power, okay, it also is important that how much can you influence or control the company. Now, are they both not same or different? Well, if you see a company like Apple, which is so liquid, right? Or which I would say so, its shares, most of its shares are floated in the market. Okay. In such a company, even if you have a 2% stake, you can have a sizable control. Okay. But if in another company, which is government company, and even if you have a 20% stake, you might not have a control. So percentage stake gives you the voting right, but the ability to influence or control the company, the invested company, which is here called as investee. So there are 2 categories here: investor and investee. Investor is the one who invests, that is us. And when we invest in a company, that's called investee. So percentage of ownership is one thing, correct? But ability to control and influence is altogether another thing. So it's not that only that higher percentage means higher control. Technically, yes, you have a higher percentage means you should have higher control, but it is slightly different. Sometimes even with a lower percentage, you can have a higher control, and sometimes even with a higher percentage, you might not have a control. Now, based on this ability to control and ownership, there are 4 categorizations of these intercorporate investments. The entire topic is based on this 4 categorization. Okay. Number one is investments in financial asset. Yes, sorry. Investment in financial asset. This is when your investment in the particular company or investee, I'll use the word investee, when you have invested around 20% or less, that's called investment in financial asset. But when you invested more than 20%, between 20 to 50%, that is what we call as investment in associates. Yes. So investment in financial asset where let's say you have 5 to 10% stake, which is considered more of a passive investment. Here, your ability to control or influence is not as high as it would be in the other part, right? But when I say you are investing 20 to 50 percentage, that means you can have a significant influence on the company's business operation because you are a major stakeholder in this case, right? Major, I don't mean by more than 50 percentage, but 20 to 50 is a substantial part of control, correct? Right? Here, significant influence. What do I mean by influence? How can I influence a company's operation? There are various ways. First, I can claim a board representation by having a seat in the board, right? Involved in policy making, key decision makings, I will be asked, right? Material intercompany transaction, yes. Now, this is very important. This is something where, because let's say I am a 40 or 50% stakeholder, and I can have good amount of intercorporate transactions, means I can buy or sell to the investee company. See, for example, many companies many companies, to reduce their cost, they do vertical integration. What is vertical integration, guys? They acquire their suppliers, they take a major stake in the suppliers. For example, today, if Tesla is heavily dependent on the battery maker, of course Tesla makes its own battery, but what if Tesla acquires one of the battery makers? Now, by doing so, Tesla will reduce its cost substantially by taking over the supplier. So when you take 40 or 50% stake in a supplier, you can do a lot of intercorporate transactions. You can buy and sell products between both to reduce your cost. So those are called intercompany transactions. Interchange of managerial personnel, yes. If you have a good amount of stake in the company, your executives can be a part or in the strategy of that investee company, or investee company's key personnel can be an advisor or a board member in your company. So exchange of people is also possible. And dependence on technology, as I said, that I might be heavily dependent on technology of that chip company, or that tire making company, or that battery making company, right? So exchange of technology is also quite possible when you have a substantial stake of 20 to 50%. This is called investment in associate. Understood, everyone? Correct. Now, as I said repetitively, that even with less than 20%, you can have a significant influence, right? And in this case, investment will be considered as investment in associate. Very, very critical thing. Now, as I said, anything which is less than 20% is called investment in financial asset. However, if you have the same amount of control as you would had if it was 20 to 50%, then even if you don't meet the technical criteria, you are considered as investment in associate. Your investment is considered as investment in associate, guys, if you are able to control the investment, or if you are able to influence the company, right? Everyone? On the opposite side, see, opposite side is possible. Opposite side is that even if you have 20 to 50% investments, and still if you can't control, or if you don't have influence on the company, then such an investment will be considered as a financial asset, not as an investment in associate. So very important, it is not only about the percentage of the stake, but it is also about how much you can influence the company. So even if you meet the percentage criteria, but if you can't influence, then you cannot be called as that investment cannot be called as investment in associate. It will be called as financial asset only. Understood, everyone? With this, please confirm. Check, check, check. Right? Okay. Now, there are different ways of recording these investments and valuing these investments. For investment in associate, we are going to use a method called the equity method. Yes, we are going to use a method called the equity method. I want you to write down here. We are going to use a method called equity method. What is the method that we are going to use to classify or record the investment in financial assets? We'll see that in a moment. In fact, You have seen that in level 1 also. Yes, I will show you that in a moment. Okay. Everyone written this equity method for investment in associate? Check, check, check. Please confirm. Right? Okay, two methods we've considered, right? The third method, the third investment structure where your investment is not only between 20 to 50, but further higher than that. This is called business combination. Yes. Business combination. Investment in financial asset, investment in associate, now business combination. Business combination is where your ownership is more than 50%, means you are a major stakeholder, correct? This is where you have a controlling investment. You are a major stakeholder, and when investor can control the investee, we use a different method that is called acquisition method. Acquisition is method is used to account. So there are two types of method. Equity method, when you are having investment in associate, correct? But when you are in the controlling stakeholder, you use acquisition method. We are going to discuss what is equity and what is acquisition method in a moment. But this is done when you have a business combination. Now, there is a possibility that even after having more than 50%, you may not have control. Why? For example, control may be temporary or barriers may exist, such as bankruptcy or governmental intervention. As I said, even if you have 60-70% stake, but if there is a bankruptcy code of conduct, or if there is a government intervention because it's a bank or something, you still do not have a control. In fact, many of the promoters who have a substantial stake in a bank, government forces them to sell off the stake, and you, even after having a substantial stake, you still have no control on the investment. Now if that is the case, then you cannot classify the investment as controlling. So as I said, controlling is not about only the percentage, it's about how much you can influence. Understood, everyone? Correct, correct. So with more than 50% also, there is a possibility that you can't control. And with less than 50% also, there is a possibility you can control. So control is not restricted to the percentage of share. Are you with me? Understood? Everyone, please confirm. Is control restricted to the percentage share? Not necessarily. Clear? 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 Yes, majorly our discussion is going to be on these four structures. First, investment in, we call when your stake is less than 20%, it's called investment in financial asset, then investment in associate when 20 to 50%. Third, investments in after associates, we have business combination where your stake is more than 50 percentage. And fourth is where you have a joint venture. Joint venture is when two or more entities come together, right? So a joint venture is an entity whereby control is shared by two or more investors. Here also, both IFRS and US GAAP want you to use equity method for joint venture. So apart from business combination, where you are required to use acquisition method, whether it's investment in associate or whether it is joint venture, you are required to do equity method of accounting, which we will see what exactly that is, right? But apart from equity method, in rare case, IFRS and US GAAP do allow another method called proportionate consolidation method, which we will see in a moment. So actually, there are three methods: equity method, acquisition method, and proportionate consolidation method. Which one is to be used and how? That is what the entire topic is all about. Confirm? Understood, everyone? Check, check, check. Okay. So let's see the question related to it. A very nice summary. Ownership less than 20%. What is it called? Investment in financial asset. More than 20%, 20 to 50% investment in associate, for which we use which method, guys? Investment in associate is equity method. Equity method. More than 50% business combination, we use acquisition method. Less than 50 less than 20 percentage, we are going to discuss in a moment. This is exactly same to level 1. I will surely discuss in a moment, so wait for it. It is basically three categories which you might be aware, which is called amortized cost, or it is called FVPL or FVOCI, which was also called as per US GAAP as held till maturity, held for trading, and available for sale. If you recollect, if you don't recollect, don't worry. Okay, I'll discuss that in a moment. So three categories: A, B, and C. And in fact, there is fourth category, which I said is joint venture, where two companies come together or two or more companies come together. In that also, we use the equity method. So I will add one more here is equity method, or we use proportionate consolidation method. Proportionate consolidation method. This is used in the case of the fourth structure, that is joint venture. Joint venture is where generally we use equity method only. Joint venture is where the control is shared. So I will write here shared control. Everyone with me on this? Check, check, check. Have you added this? Now my table is complete. Understood? We use equity method only, and this one is rarely used. Okay, we will discuss all the method in a moment. Confirm? Check. Let us do this. Tall company owns 30% common equity of short. Tall has been unsuccessful in its attempt to obtain representation on the board. Now, guys, even though my stake is more than 20%, I'm not able to obtain a board representation. So I'm not able to have my influence. Will I classify this as investment in associate or investment in financial asset? Please confirm. What will I classify it as? What will I classify it as? Investment in financial asset. Yes, correct. So even if the stake is greater than 20%, I still cannot classify investment in associate. Understood? So it's not only about the percentage, it's also about your ability to influence. Clear? Clear, everyone? Yes. So four categories: investment in financial asset, investment in associate, business combination, joint venture. In fact, there is fifth category also we will see, that is SPE, special purpose entity. So the entire topic is all about this. Many students get confused and get, find it very complicated. So we are going to systematically do everything step by step. Okay. So patience is the key here. Let us start first with, yes, investment in financial asset. This is category number one, investment in financial asset. Remember here, when we do such an investment, when we classify it as investment in financial asset, when the investment is less than 20%. Now here you will see this is done as per the merge standard. When IASB and FASB, IASB International Accounting Standard Board, which is IFRS, and FASB, that is US GAAP, they both have common standard, similar standard for accounting of this now. Previously, when I did my CFA, it was very complicated. Now they have merged accounting standards. So that's why you will see a common term here as per IFRS, but both agree to the treatment. So there is no difference here. Okay. Now, there are three categories. I will directly go to the categories. Rest of the thing you don't have to worry. When you invest less than 20% in any company's debt or equity, less than 20% in any company's debt or equity, it can be classified either as amortized cost, FVPL, fair value profit loss, or FVOCI, fair value other comprehensive income. Okay, now these are IFRS name, but US GAAP, as I said, have their name is called held to maturity. US GAAP has a name called held to maturity. FVPL is also called held for trading, trading. And FVOCI is called available for sale. It will be there in the notes also, don't worry. It will be mentioned in detail. Now, guys, based on these three classification, or based on the choice of this classification, your impact on balance sheet, income statement, and other comprehensive will be different. Okay. it, I will show you a summary of it, but based on that summary, we will do questions, and there are many questions related to it. Okay. So you will need patience to step by step understand. First of all, Let me do it exactly the way I do it in level one. What are the three categorization here? Okay. So I will name the categorization as this is investment in financial asset. Okay. You can also write with me. The IFRS name, the IFRS name for it is IFRS name is actually based on exactly how the treatment is. So IFRS name is much more better. IFRS name is called amortized cost, correct? Or amortized cost. Then the other name for another treatment, another category is called FVPL, fair value profit loss, and FVOCI. These are the IFRS name. US GAAP has the same treatment but has a different name. US GAAP has a name. Amortized cost is called held till maturity. Held till maturity. FVPL is called as held for trading, and FVOCI is called available for sale. Means you are not going to hold them till maturity. You will sell them, but not immediately. That's called available for sale. So three choices are given to you under the category of investment in financial asset. We are doing investment in financial asset. Again, I'll repeat, this is exactly what we do in level one. Okay. Now, before I go ahead and explain you the treatment, how the treatment is done on balance sheet, income statement, and OCI, okay, what exactly will go into the balance sheet, what exactly will go into the OCI, what exactly will happen into the income statement, let me tell you what type of securities fall under these categories. So, securities that fall under amortized cost. Can you tell me that does debt have maturity or equity have maturity? Who has maturity? Debt or equity? Who has maturity? Everyone. Yes, it's only debt who has maturity, right? Does equity have a maturity? No, equity doesn't have a maturity. Only debt has a maturity. So when I say amortized cost or held till maturity, we are assuming which security have we invested? We've invested in the debt security. But when I say FVPL or I say FVOCI, fair value can be for debt, okay? But fair value here, it's not about maturity. So fair value can also be about equity. So fair value can be about debt, fair value can be about equity, fair value can also be about those derivatives that you are using but not for hedging. So I'll write down here. Fair value can be for debt, for equity, and even for derivatives. Which derivatives? Those which are not used for hedging. Understood? That is where we use the fair value reporting. Again, the same you can classify here. It can be for debt, it can be for equity, and it can also be for derivatives. Correct? All three categories: debt, equity, and derivatives. I'll just write it down here to save the planet. Okay. Okay, these are the securities. Now we are going to understand how the treatment will be on the balance sheet, in the income statement, and in the third category of OCI. Yes. So what will happen in the balance sheet? What will happen in the income statement? What will happen in the OCI, other comprehensive income? Now, even before I go ahead, let me tell you, on the balance sheet, the value of the asset, because it's amortized cost, it will be at amortized cost only. Value will be based on amortized cost. What is amortized cost? I will just discuss with you in a moment. But in the other two category, as the name suggests, it has to be based on fair value. Fair value. Got it? Fair value. Yes. Now, what do I mean by amortized cost and what is fair value? Let me show you that in a moment. Everything is, by the way, mentioned here, whatever I've shown on the table. Debt securities meet the criteria. what is the additional thing about the criteria that said criteria for amortized cost accounting? Number one, business model test. What do I mean by business model test? Debt securities are being held to collect contractual cash flows. So that's the reason why you're holding them till maturity. And cash flow characteristics, contractual cash flows are either principal interest or principal only if it's a zero coupon bond. So these are the types of securities that fall under amortized cost. Now, the treatment of this, as I said, on the balance sheet, they are reported at amortized cost. But if you carefully see fair value through profit and loss, fair value through profit and loss, they've said your equity, it can be derivatives that are not used for hedging or even debt securities. But on the balance sheet, they're recorded at fair value. Similarly, FVOCI, they are carried on the balance sheet at fair value. So that's the reason why all three I have put differently on amortized cost or on fair value if it is FVPL and FVOCI. What exactly is amortized cost? I will show you that with a number. Okay. Let me show you first. So see this, everyone, on the screen. At the beginning of their Midland Corporation purchased 9% bond with a face value of 100,000 for 96,209 at a yield of 10%. Guys, just for your reference, purchase a 9%. So coupon was 9% on 100,000, that is 9,000, right? Correct. Purchase a bond with a face value. Face value of the bond they have given is 100,000. Correct. Present value of the bond was 96,209 and YTM on the bond is 10%. Clear? Okay. Yes. Have we been given year? No, we are not given year. The coupon payments are made annually at the year end. Suppose the fair value of the bond at the end of the year is 98,500. That is a fair value. So this is going to be my fair value. And this present value is my original cost. Now, guys, tell me, since you have already, I'm assuming you have reached this point after doing the fixed income. It's a premium bond, discount bond, or a par bond, everyone, visibly. It's a discount bond. Am I correct? So discount bond gradually every year, will it increase or decrease? Using the pull to par effect, a discount bond should every year increase. That increase in that bond every year is called amortization of discount. So amortization of discount is added, so the value of the bond increases by maturity. It has to become par. How would I calculate that? How would I know, or how would I calculate that? First of all, the way to calculate amortization is that the bond's present value is 96,209 and the yield on the bond is 10%. So if you multiply that with 1.1, if you multiply 10% of it, my mistake, 96,209 into 10% of it, what is the value that you get? 10% of 96,209, you get 9620.9. That is approximately 9621, right? So 9621 is the value that you get. Out of this, 9,000 is the coupon, isn't it? So the balance 621 is what we call as amortization of discount. This will be added in the first year. So 621 is what, if we add to 96,209, that should be the amortized cost of the bond, everyone, at the end of the first year, which is equal to how much? Which is equal to anyone? Yes, you will get that value 96,830. If you add 621 to 96,209 was our previous first year value, plus I add the amortization of discount, I will get 96,830. This is called my amortized cost. Now, what is amortized cost? Amortized cost, if you carefully see here, amortized cost, please, everyone, you can highlight that with me. Amortized cost is the original cost of the debt plus any discount. In our case, it was discount, so amortization of discount, or minus any premium. If it's a premium, the value will go down, so we minus. Understood this point, everyone? So I'll write down here amortized cost. What is amortized cost? Everyone, we will write down amortized cost is equal to the original cost of the bond. This is your PV of the bond, correct? PV at the beginning, plus and minus. What will be plus? Plus any discount on the bond, or we call it as amortization of discount. So every year the discount that is amortized gradually, or we subtract the premium. Understood? So this is what we adjust every year. So then what we get is called the amortized cost of the bond. Everyone with me on this? Clear, 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 confirm, right? Now, this is what the amortized cost of the bond should be on the balance sheet. On the balance sheet, the company's bond value should be 96,230 at the end of the first year if I am going to use amortized cost. But guys, this is if we use amortized cost. If we are using fair value, whether through OCI or whether through fair value through PL, what is our fair value given to us? They said the bond's fair value was 98,500. So on the balance sheet, we will record 98,500 only. So on the balance sheet here, the value will be 98,500. Everyone with me? Correct, 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 correct. So now if I categorize this, what will happen on the balance sheet? What will go into the income statement and what will go into the OCI, that depends on what category of investment have I recorded. If it is amortized cost, in our case, what will be the amortized cost? 96,830. 96,830. Otherwise, it is going to be 98,500. Sorry, 98,500 if it is recorded as FVPL or FVOCI. Now guys, in the balance sheet I record the value, correct? But is there any unrealized gain or loss? Yes. Unrealized gain or loss only occurs when you record at fair value. So unrealized gain and loss is the difference between the fair value and what the value should be. So in our case, what is the value that it should have been? Well, it should have been the value that we got. The value, original value was 96,209. Correct? This was the value. And then we added the discount rate. So the discount amount each year was, we got the discount amount as 621. So after that, the value should have been 96,830. Am I correct? So this should have been the bond's carrying value, but the market value was 98,500. Isn't it? 98,500. Okay. Now, due to this, the value is 98,500. But if you notice, the carrying value of the bond or the amortized cost of the bond was supposed to be 96,830. So this 96,830 is also called the carrying value of the bond, but the market value of the bond was 98,500. So the difference between both is 1670. How did I get this 1670? 98,500 minus 96,830, which was the carrying value of the bond. If you check this, 96,830 minus 98,500, that 1670 is called the unrealized gain on the bond, because the fair value is higher. Everyone with me on this unrealized gain? Now, this unrealized gain, what are we supposed to do with unrealized gain? Where should I record it? This unrealized gain will not occur if it is amortized cost. There is no unrealized gain. There is no unrealized gain. But if it is held for trading where you are going to do record at fair value, in this case, the unrealized gain and loss is recorded in the income statement because it is FVPL, profit loss. So in the income statement, but FVOCI, in this case, the unrealized gain and loss is recorded directly into the equity under OCI, other comprehensive income. So the name itself is the key. PL means profit loss. So unrealized gain and loss is recorded in the income statement. Here OCI means the unrealized gain and loss is recorded in the other comprehensive income. Everyone with me? So if you will notice here, the unrealized gain and loss of 1670 is recorded in the income statement if it is FVPL, but if it is FVOCI, this 1670 is recorded in the OCI. What is OCI? Other comprehensive income, which is a part of the equity, stockholders' equity itself. Everyone with me on this? Check, check, check. What is unrealized gain and loss? So I'll write down here, unrealized gain and loss is the difference between the carrying value. Carrying value is amortized cost and fair value. That unrealized gain and loss will only appear if it is FVPL or FVOCI. Only in this case there is unrealized gain and loss. Understood everyone with me? Check, check, check. Confirm. Right. And guys, there is something called realized gain and loss. What is realized gain and loss? So guys, any coupon that you receive or dividend that you receive, those are called the realized gain and loss. Realized gain and loss, guys, irrespective of the classification, sorry, the classification that you have, the realized gain and loss are always and always recorded in the income statement. So realized gain and loss, realized gain and loss, realized gain and loss are always recorded in the income statement. So the problem is not about realized gain and loss. It's either about the balance sheet, how the balance sheet is recorded. For example, in these two categories on the balance sheet, we record it at fair value, which will be provided to us like this example, or it is about, because it is fair value, so that unrealized gain and loss, where is it recorded? Either in profit loss or in OCI. But if it's amortized cost, there is nothing recorded as unrealized gain and loss. Understood everyone? Check, check, check. Confirm this. Okay. Now, so here in the income statement, I will have my, let's say my coupon of 9,000 will be in the income statement. That is my realized gain and loss. I will write plus. For amortized cost, nothing in OCI, but for FVPL, we discussed that there was unrealized gain. Unrealized gain of how much? 1670. So this 1670 will be recorded here. But for FVOCI, this 1670 will be recorded in other comprehensive income. Everyone with me? Check, check, check. This is how the recording will work for this particular question. Check. Understood everyone? Clear, clear, clear. Now, by the way, we've done this exactly similar in level 1 under the topic of balance sheet. Okay, here it is the same thing, no difference. Okay, because we are recording for investment in financial asset where your investment is less than 20%. Okay, understood everyone? Right. Few more things before we hit the question is that, can I reclassify any of my investments? Is it allowed? Now that depends whether it is equity or debt. For example, reclassification of equity is not permitted. Means when you record it as FVP or FVCL, they are saying it is irrevocable. Once you record it at fair value, it's irrevocable. Of course, equity cannot be at amortized cost. So equity allowed or not allowed? No, not allowed. Reclassification of equity, not allowed. But debt, yes, debt is allowed. See this, reclassification of debt securities is permitted only if the business model has changed. Yes, for example, unrecognized gain and loss on debt securities carried at amortized cost and reclassification are recognized in the income statement. Remember, when they were amortized cost, there was no unrealized gain and loss. But when you reclassify them as FEPL, so any unrealized gain and loss should be recorded in the income statement. Understood, everyone? Clear, 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 clear. Debt securities that are reclassified out of FVPL are measured at amortized cost, are transferred at fair value. So they get converted into fair value whenever you do the reclassification. This is what tells us whether reclassification is allowed or not. For equity, no. For debt, only if the business model has changed, only then it is allowed. Otherwise, reclassification is not allowed. Clear? Also, since we are talking about investment in another company, what if you have given loans to someone else? When you give loans, even the loans are classified as investments. Now, there is some changes with regards to loans. Okay. Now, a key feature of IFRS 9 was that incurred loss model for loan impairment was replaced by expected credit loss model. What exactly is the issue? When initially, when you were giving loans to others, okay, those loans did not had the component of what if the loans are supposed to get default. Okay. So gradually what happened is that after the crisis, financial crisis, there were many loans default. Now, if the loans are on the verge of default, they are called non-performing asset. What are they called as? Non-performing asset. Now, how will I know whether an asset is performing or non-performing? So the financial reporting standard have now become more strict. They want you to recognize the impairment of this asset. Impairment means the loan is not expected to come back. It is expected to default. So this requires companies to not only evaluate current and historical information about loan, but also forward looking information. So now whenever we give loan to others, if we classify that as investments or loans and advances, right, that's our asset, right? In that case, we also have to give them expected credit loss, means we have to give them, we have to recognize the impairment. What is impairment? That 12-month expected losses for performing loans and lifetime expected losses for non-performing loans. What do I mean by that? That any loan which is not expected to revert or not expected to be paid back, that recognition of that impairment or recognition of that potential loss also needs to be now disclosed. Okay. This is just an information. Don't expect any calculation on this. Calculation will be based on the three classification that I mentioned. So let's do calculation based on that. Okay, everyone, let's see this. Kirk Company acquired shares of both Company A and Company B. We have following information from the public market about Company A and B at the time of purchase of the two subsequent dates. Okay. So they have acquired shares. Acquired shares. Now, guys, you know, when you acquire shares, is it classified as amortized cost or FVPL and FVOCI? Well, debt can debt be FVPL, FVOC? Can equity be amortized cost? No. When I say acquired shares, it can either be FVPL or FVOCI only. Am I correct? Can be at amortized cost? Can equity be at amortized cost? No, 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 no. So when I say shares, it is either FVPL or FVOCI. Now they haven't mentioned whether it's FVPL or FVOCI. Okay. Now we've been given cost at the beginning, at the end of first year, and at the end of second year. Kirk Company will report initial value of its investment as very easy. What will be your initial value of investments in both the companies? 950 plus 250. That is supposed to be how much, guys? 1200, right? Easy, clear? That was easy. The important is that at the end of first year, since it is fair value, we will also consider the fair value. What is the fair value at the end of the first year, everyone? 850, everyone, plus 180, isn't it? That will be the fair value. Now, if you calculate 850 plus 180, 850 plus 180, well, that shows 1030. So this was initially it was 1200. Now it shows as 1030. So guys, is that a gain or a loss? Is that a gain or a loss? Based on fair value, now at the end of year two, the value is 850 plus 180, which is equal to 1030. So if you see from 1200, 1030, there's a $170 loss, right? Isn't it? This is unrealized gain loss, isn't it? So, how should we record it? Carry at the financial asset at cost? No, it's at fair value. Write down the financial asset to 1030, correct? And recognize an unrealized loss or a realized loss. Which one? Unrealized or realized, guys? This is unrealized. Am I correct? Right. So the only difference between both B and C is the word unrealized or realized. Well, we record it as a unrealized loss of 170. Easy. Everyone understood? Perfect. Next, at T2, Kirk will report carrying value of its financial asset as, simply take the fair value. So 900 plus 350. So we'll take 900 plus 350. That is, everyone, yes, what will be my carrying value? 1250, isn't it? 1250. Easy, easy. Why? Because it's all based on fair value. Got it? Now, see, the concept sounds so complicated, but the questions are not so. Based on the information provided, which of the following statement is most accurate? Classifying the shares at fair value through profit loss would result in greater reported earnings volatility. Yes or no? Now, guys, when you do FVPL, in your income statement, is there only one thing or multiple things? See, it's only in FVPL, there are two things in the income statement, and one of them is the unrealized gain and loss, which will cause your income statement to become quite volatile. So, yes, choice number A is correct. Why? Because under FVPL, guys, it is only under FVPL, you not only record the realized gain and loss, but the unrealized gain and loss. So any change in the value of asset, that is constantly going to reflect in the income statement and make it more volatile. Are you with me? But why B and C are wrong? Let's understand that. Classifying the share as fair value OCI would result in a 220 realized gain between T1 and T2. Realized? No, it cannot be realized. It has to be unrealized. So the word realized is a problem here. Okay. It is optimal. See, first of all, from year 2 to year 3, yes, from 1030, okay, to 1250. If you check here, 1250 minus 1030. So yes, there is a 220, but it's not realized. It's unrealized. So the problem is with the word. It is optimal to classify its share in company and be as fair value through P&L since it results in a net gain of 50. No, when you do when you recognize as FVPL, you get a net gain of 50 gain recognized on the income, net gain of 50. No, your gain is actually more than 50. Why? Because in the first year, you can say that there was a gain, there was a loss. And the second year, there is a gain of 220. Understood? But remember, when you do FVOCI, when you record it as FVPL, it is not only the unrealized gain and loss, but also the realized. So that's why C is wrong. So A is the correct because FVPL is going to be the most volatile because of recognition of not only the realized, but also the unrealized gain and loss. Clear? Suppose for this question only, security A and B are both debt securities carried at amortized cost. Amortized cost means not at fair value and purchased at par. At par. So what is their value at the beginning? 950 plus 250, right? So at the beginning, their value was 950 plus 250, that is 1200, right? Now, if they are recorded as amortized cost, whether it's year one or year two, their carrying value will remain the same only. So the question, whether it's year one or year two, if it's amortized cost, it will remain at 1200 only. Are you with me on this? Understood, everyone? Check, 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 check. Confirm, right? Okay, everyone. This page, very important. Clear, 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 clear. Any questions? Remember, out of the four categorization, that is investment in financial asset, where the investment is less than 20% is what we are done. Now we will do investment in associates, where we are also going to understand what is the equity method of accounting. Then we'll do business combination, where we'll understand the acquisition method. That is going to be the key focus, because majority of the questions are going to be on investment in associates. So now, from investment in financial asset, as I classified it as first, now we move to investment in associates. This is where we are going to understand what is equity method. Yes, everyone with me on this point? Check, check, check. So, investment in associates. Investment in associate, remember the criteria here is when your investment is substantial, in the sense 20 to 50%, and you can influence, you can have an influential investment, right? So investment in associate basically means when your investment is between 20 to 50% and is usually considered influential, right? Here we are going to use a method of accounting which is called equity method. What exactly is equity method? We will see that through the example. But just to give you some idea here, under equity method, initial investment is recorded at cost and reported on the balance sheet as a non-current asset. Yes, we are going to report on the balance sheet as a non-current asset. There's no trouble in that. We already know that. But it is recorded at cost. Okay. Now, this is what we will do at inception, means when time is zero. When later on, what will happen in the subsequent period? The proportionate share of investees earning, investee means the company where we are investing. So whatever their earning is, times how much percentage is our stake. That is called proportionate share of investees earning, increases the investment account or investor's balance sheet and is recognized in the income statement. Fine. So whenever the company where you have invested, the investing company's profit increases, proportionate share of that profit is yours. So what will happen? Your income statement will also go up. However, when that company pays dividend, right? Dividend is paid to the investors. So you will receive the cash dividend. However, your earnings will go down by the amount of dividend. Yes. So dividend received from the investor are treated as return on capital. Why? Because they are return on capital and reduce the investment account. Yes. This is very unique. And even though I'm reading it, you will understand it when I show you that in the numbers. Unlike investment in financial assets, dividend received from investee are not recognized in the income statement. So these dividends are adjusted not from the income statement, but from the equity. Your investment account goes down, right? So yes, your net income will increase by the increase in earnings of the investee. But whenever the investee pays dividend, your cash inflow will be increased, but your investment account will reduce, because when the company pays out dividend, money goes out of the system. So the value of equity goes down. Okay. This is what when the company makes profit, if there is a gain. If there's a loss, what will happen? If the investee reports a loss, mostly you will have a scenario where there is a gain. If the investee reports a loss, investors' proportionate share of loss will reduce the earnings. So if your earnings were increasing when the company was making profit, when the company is making loss, your earnings will go down, right? And investees loss reduce the investment if your investment becomes zero. Is it possible? Yes. When you invest in the company, in another company, or by taking 30-40% stake, what if that investment becomes zero? What if that company becomes bankrupt? In such a case, your investment account will become zero. Investor usually discontinues using of equity method. So your method will stop, equity method will be discontinued because the values have become zero. The equity method is only resumed once the proportionate share exceeds the share of losses that were not recognized during the suspension period. Now, what do I mean by that? I'm just reading it and trying to explain you, but although the explanation won't be, relatable unless I show in a number, means if there is a loss, okay, the equity method gets discontinued and you are no more recording because the investments have become zero. You will record the investment, your investment account will be reflected again only and only when they said when your earnings exceed the share of the loss. So when your proportionate earnings are higher, so your earnings are positive than the loss that were recognized before. So whatever your loss was recognized, if your proportionate earnings are positive, only then you record it. Basically, you don't have to understand how it is going to be reflected in the financial statement. More of you need to understand how the gains will be adjusted and how the dividend will be adjusted. So let me show you that in a moment. This is what we are going to do under the equity method. So first, let me show you how this works under the equity method before I discuss the fair value under US GAAP. Okay. So see this. Suppose that we were given December 31st, 25, company P invests 1000 in return for 30% of the shares in S. So P is the investor and S is the investee. Guys, how much have you invested? Remember, you have invested $1,000. Okay. And in return, you got how much stake? 30% stake of the company S. During 2006, company earns 400 and pays 100 as dividend. So this is in the first year after the acquisition. Okay. Now, guys, 400 is the company's earnings. Out of that, how much belongs to me? How much belongs to me? 30%. So what is 30% of 400? 400 into 0.3, that is 120 belongs to us. So we will add 120 because our investment account will increase. Am I correct? However, company pays a dividend of 100. So 30% of 100, that is minus 30 because dividend is going to reduce my investment account. So everyone, what will be my investment account? Final, my investment account will be, the final in my investment account will be 1090 at the end of first year. Everyone understood this? This is called equity method. So we recognize 120 as our proportionate share of earnings. And what do we do rest? Our investment account increased, but the dividend that was paid proportionate to that dividend, our investment account will reduce. So at the end, your value will be 1090. Everyone with me on this? Clear? This is what will happen in year one. Everyone understood? Correct? See this. This is what will happen in first year, right? Now they have given me second year also. So guys, what will happen in year two? In year two, what was your investment account balance at the beginning? Your investment account balance was 1090. Correct? They said during 2007, company earns 600. So 600, proportion of 600, 30% of 600 is 180 will be added and 150 is paid as dividend. So 30% of 150, that is 45 dividend will reduce my investment account. So 1090 plus 180 minus 45. My balance will be 1225. Understood, everyone? This will be the effect on investment account. So you're in the second year, this is what we discussed in first year, right? In the second year, what will be my final balance sheet value of investment? 1225. Everyone with me? Understood? 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 Please confirm. Check, 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 check. Everyone. Yes. Any questions, anyone till this point? Right? Okay. I will also show you how This is reflected in the financial statement in a moment. Okay. But this is how what we do is the proportionate income is what we add. And if there is a dividend paid, so that proportionate dividend is subtracted from my investment account, because it's like your equity value will go down when the companies pay dividend. Got it, everyone? Right? This is called equity method of accounting. Understood, everyone? Yes. Now, this is what generally will be preferably asked in the exam quite, quite. I've seen investment in associates is very frequently asked, especially this equity account, because this is very easy to do also. And mostly investment in associate is what you will see in the exam. But here, what we considered is that we paid 30% to acquire the company, but nowhere we discuss that whether we paid to the company an amount equal to its book value or more than its book value. Because you know that no one buys the company at its book value, right? You actually pay more than its book value, isn't it? What is that called as, by the way? If you remember something? Yeah, I have a question here. All adjustment earnings and dividend done after the book of investing certified by auditor. Uh, what is the question of auditors here? This is nothing related to auditor. Auditor's job is to audit the financial statement, right? How is auditor coming into this picture? I didn't get it. Can you rephrase your question and put it again? First of all, this is the exact method that you have to publish, uh, acceptable under IFRS and US GAAP both, right? And of course, at the end of your financial statement, everything is audited, isn't it? So I don't know the question of audit. I didn't get it. Now, coming back to the system here, that first of all, when we were discussing that when you buy another company, okay, you don't only buy at their fair value or at their book value, you actually pay more than the company's fair value. That extra amount that you pay to the company over and above its fair value, what is that called as? Can you please answer, everyone? What is the extra amount that you pay to the company over and above its fair value? What is it called as? Yes, yes, yes. Anyone, anyone? Well, that is called as goodwill, isn't it? Goodwill, 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 accounting goodwill. Accounting goodwill is the extra amount that you pay over and above the net asset value of the company, right? So rarely does the price paid for an investment equal to the proportionate book value, correct? At the acquisition date, the excess, see the excess of the purchase price over the proportionate share of investee's book value. So whatever the investee's book value is over and above what you pay to the company, that is called as goodwill, is allocated to investees' identifiable assets and liabilities on their fair value. Remember, based on the fair value of net assets. When I say net assets, only identify only identifiable. If the company already has some goodwill, we ignore it, right? We will see that in the financial statement also. For example, here, see this question, everyone. At the beginning of the year, red company purchased 30% of blue company for 80,000. So how much was paid to acquire the company's 30%? 80,000. On acquisition date, blue's identifiable net asset was 200,000. So company's net asset was 200,000, but there were some adjustments. Also, the fair value and book value of assets and liabilities were same, except for Blue's equipment, which had a book value of 25,000 and a fair value of 75,000. In this case, guys, that means the net asset value, which was initially 200,000, should be increased by 50,000, isn't it? Because 25, from 25 to 75, 50,000 additionally should be added. So it should be 250,000. Am I correct? The revised net asset value based on fair value, correct? Blue's equipment is depreciated over 10 years using the SLM. This we will discuss. At the end of the year, Blue reported a net income and dividend. They are asking me, calculate the goodwill. Now for goodwill, I need two things: how much amount I paid and what is the proportionate value of the company. Guys, how much amount did we pay to acquire How much stake? 30% stake. For 30% stake, we paid 80,000. 80,000. Now, ideally, for 30% stake, we should have paid how much? How much? Based on the revised fair value. What is the revised fair value? 250,000. So what is 30% of 250,000? Please calculate, everyone. 250,000 into 0.3, you'll get 75,000. So 75,000 was the proportionate value, but we paid 80,000. So what should be the goodwill, everyone? That 5,000 extra that you paid is called as goodwill. Are you with me on this, everyone? I will explain you how they've calculated, everyone. So first of all, our purchase price was 80,000. Pro rata, they did pro rata book value of the net asset was 60,000 based on the initial 200,000. That is 20,000 was the excess price. But then we did the adjustment. So the extra amount that was 50,000, that 50,000's 30% of that 50,000, they readjusted and then they got the goodwill. Now, I generally don't do this way. I actually calculate the purchase price, which was 80,000, and the fair value of net asset was 250,000 into 250,000 into 30%. That is this, the extra amount is what I call as the goodwill. So I use a different way. You can use the step-by-step way that they've discussed. No problem. Both will give you the same result. Everyone with me? How the goodwill is calculated? Check, check, check. Correct, correct, correct. Okay. So this is, until now we did not, before this point we had not done the discussion of the acquisition over where you pay more than the fair value. If you pay more than the fair value, we recognize goodwill. Correct. Now this is what we do on the acquisition date, that is on day one. Okay. Later on, investor recognizes expense based on the excess amount assigned to investees assets and liabilities. What do I mean by that? Remember, goodwill is recorded on the balance sheet, isn't it? And if there is anything related to goodwill that will reflect into the income statement, can you tell me, is goodwill amortized? No, goodwill is not amortized, but remember, goodwill is tested for impairment, isn't it? Correct. So keep that in mind. The expense is recognized consistent with investee's recognition of expense. For example, investor might recognize additional depreciation as a result of fair value allocation of the purchase price to the investee's fixed asset. Now see this interesting thing. So they are saying the investor might recognize additional depreciation. Why? Because the asset were revalued at a new price, right? For example, here, what was the assets book value initially? 25,000 and it was revalued at 75,000. Now, how much extra valuation come up into the picture, guys? 50,000, right? This 50,000 also will be depreciated over 10 years. So 50,000 divided by 10, each year extra depreciation will be how much, everyone? 5,000, correct? For the asset, right? And 30% of that 5,000, because I'm taking 30% stake, right? 30% of that 5,000 is 1,500, isn't it? What about this 1,500? Well, if we are asked to calculate Red's income at the end of the year from its investment. Now, income will be based on how much was the income of the investee company. So blue company reported income of 100,000, of which 30% belongs to us, isn't it? So 30% of 100,000, that is 30,000. However, you need to adjust for the additional depreciation also. So when we adjust that depreciation, what will happen? My equity value will be 28,500 now. Understood this part? What happened? The value will become now 28,500. Why? Because we adjusted for that additional depreciation expense. Is this clear, everyone? Correct? How did I get 1,500 is here? Clear? Understood, everyone? Right? See, that's what they mentioned here. that for example, investor might recognize additional depreciation expense as a result of fair value allocation of purchase price. So because we valued the asset at the fair value, that extra valuation and because of that extra depreciation will reduce my equity value. Understood, everyone? Clear, clear, clear. Yes. Also, it is important to note that the purchase price allocation to investees' asset and liabilities included in the investor's balance sheet, not in the investee. What do I mean by that? Who's going to record the goodwill? Investor or investee? Who's going to record this goodwill? Everyone? The investor or investee? It is going to be the investor who's going to record the goodwill. Am I correct? Right, right, correct. Very good. In addition, the additional expense that results from assigning amount is not recognized in the investee's income account. So any cost related to that is also recorded in the investor's account. Under equity method of accounting, investor must adjust its balance sheet, investment account, and proportionate share of income reported from investee even for this additional expense. So any additional expense related to that also needs to be adjusted. Okay. Now, anything related to that? Yes, let's see. So they said calculate the investment in blue that appears on the red's balance sheet. Now focus, how much did we invest? How much was our investment initially? If you see from that start, my initial investment amount was 80,000, correct? Then I will have to see what proportion of the net income. So 80,000 was my initial income and the proportion of net income was 30,000, correct? 30% of this. But also we had to adjust for depreciation, which we did, and our proportionate share was 28,500. So 28,500 will be added. However, remember we subtract the cash dividends. If any dividend is paid, we subtract that from our investment account. So they said dividend of 60,000 was paid. So 30% of that 60,000, 18,000 will be subtracted and the final balance will be reflecting my investment account. Okay. Same. We did what? Initial investment, right? Plus my income, proportionate income. So initial investment that you did plus proportion of the income adjusted for depreciation year less proportion of dividends paid. This is what the formula for your ending balance of investment is. Or you can say ending investment account balance. Clear, everyone? Visible? Understood? Everyone? Correct? Let's see the questions related to that now. Everyone, we are doing investments in associates. Am I correct? Where you are having 20 to 50% stake. And the method that we use this to account is called equity method. Okay. Let me show you how exactly the questions appear. If company uses equity method to account for investment in another company, income is combined to the extent of ownership. What did we do? We took our income and we take the income of the other company. But do we take the full income or do we take the proportionate income? We take the income to the extent of our ownership. So nothing wrong with A. Let's see what's wrong with B and C, everyone. All the income of the affiliate is included. No, we don't take the entire income. We take proportionate income only. Earnings of the affiliate are included but reduced by any dividends paid to the company. No, the dividends are not reflected in the earnings. They are adjusted from the equity account. Dividends are not adjusted from the earnings. Dividends are adjusted from the investment or equity account. Clear? So that is wrong. So only A was correct. Next, let's look at this question. Suppose that company P acquired 40% shares of company A for 1.5 million. So this is what was paid, right? During the year, company A earned 500,000 and paid dividend of 125,000. So at the end of the year, company P's reported investment will be very easy. Everyone, how much did we pay? 1.5 million. Income, proportionate income, you will add and dividend you will adjust. Please let me know. Please do this and let me know your answer. Yes. How much income I will add? 40% of 500,000. So 500,000 into 40% and dividend of 40% of 125,000 will be subtracted. So 1.5 million plus 0.2 million. 125,000 into 0.4 will be subtracted. Yes. Anyone with answer? Everyone? Easy, easy. 1.65 million. Everyone is getting 1.65 million. Easy. Check, check, check. Correct. Company P's reported investment income. Now, guys, they are asking only about income. This was the investment value, right? Income. Guys, income is just my share of income in that company. How much is going to be the extra income? 500,000, but not entire 500,000. 40% of that 500,000 belongs to me. That is 200,000. Isn't it clear? And company P received cash flow. Yes, you received cash flow in the form of dividend. How much dividend you received, everyone? Of course, dividend is going to lower down your investment account, but the dividend that you received was 40% of 125,000. That is how much? 12,525, 50,000. Am I correct? Easy. Understood, everyone? Clear? Anyone has any doubts? Please let me know in this. Check, check, check. Right? Everyone. This is what we call as equity method of recording your investments and net income under the investment in associates. Everyone clear with me on this? Right? This is the maximum complexity that they can ask with respect to investment in associates. Now, remember there was another part of investment in associates, and this is where we are now going to discuss about the goodwill's issue. Okay. Equity method must be tested for impairment, isn't it? When you record goodwill, we all know goodwill is not amortized but tested for impairment at least annually. Yes or no? Everyone aware about this? Check, check, check. Under US GAAP, if the fair value of the investment falls below the carrying value, right, and the decline is considered other than temporary, investment is written down to fair value and the loss is recognized in the income statement. Yes, this is called as impairment. So whenever the value of your investment falls below the carrying value, so whenever your investment value falls below the carrying value, investment value is below the carrying value, in such a case, we recognize the loss in the income statement. We write down our investment value, that is called as goodwill impairment. Exactly treatment of impairment under IFRS and US GAAP is slightly different. Under US GAAP, needs to be evidenced by one or more or loss events, while US GAAP under IFRS, sorry, under IFRS, impairment needs to be evidenced by one or more of loss events. So the treatment is slightly different in IFRS, US GAAP and IFRS treatment of impairment is different. We are going to see both in a moment. But if you recollect, goodwill is impaired whenever the value, whenever the market fair value is below the carrying value. However, later on, if the value goes up, upward revaluation, is it allowed under IFRS or US GAAP? Well, if you remember, US GAAP does not allow reversal. Only IFRS allows, and that too till the recognition of previous loss. Okay, allows reversal only to the extent of net recoverable, means any loss recognized in the future, only till that proportion IFRS allows reversal, but US GAAP prohibits reversal. US GAAP does not allow reversal of write down of inventory. US GAAP does not allow reversal of impairment of assets. It does not allow reversal in most of the things, right? US GAAP. Same way here, impairment of goodwill, US GAAP does not allow the reversal. IFRS does allow till the previous loss. Okay. Or here, technically, we say to the extent of recoverable, net recoverable amount. Okay. Only till that point. Clear, everyone? Right? This is what we had discussed about goodwill impairment in the past also. Now, this is one thing. This is about the impairment that we need to take care. Correct? Similarly, because you have a substantial stake in the company, there is quite a possibility of intercorporate transactions. If you remember, when I say you can influence the company, there is a lot of intercorporate transactions, transaction between investor and investee. Am I correct, everyone? Right? Okay. Yes, these transactions can be described as upstream or downstream. What are these transactions? Upstream transactions and downstream transactions. Yes. What is upstream? Upstream is from investee to investor. From investee to investor. And downstream is when the investor sells to the investee. Okay. Now it's a bit complex. Okay. We will see very few questions related to it, but I will have to show you exactly what do they mean by it. Okay. So first of all, let me set the ground here. What exactly are we trying to do? That in because of its ownership interest and because we have a substantial stake, investor may be able to influence transaction with the investor. Remember, I told you we also do vertical integration. Why? Because we want to reduce our cost from the supplier. So we might do a lot of intercorporate transaction. So the profit from these transactions must be deferred until the profit is confirmed through the use of sale of a third party. What do I mean by that? That you should recognize the profit only if the profits are confirmed. If the profits are not confirmed, you should not recognize. Now we will understand and I'll explain you this. So first we will understand from the point of view of upstream transaction and then from the point of view of downstream transactions. Remember, majorly our focus is how it is going to be reflected in the investor's account. Okay. So when I say upstream, it means the investee has sold something to the investor. Okay. So downstream is the opposite. In an upstream sale, the investee has recognized all of the profit in the income statement. Remember, when you calculate investment account, okay, investment value, at that time, what did you do? You took the proportionate share of the entire net income of the investee, right? So let's say investee's net income was 100,000 and your investment was 30% into it. So you took 30% of the net income. However, what if some of the profit is unconfirmed? So then the investor must eliminate that from the proportionate share. What do I mean by that? Suppose the 30% is invested by you in the investee, right? During the year, investee sold and recognized 15,000 of the profit. But they are saying half of the goods purchased from investee remained in the investor's inventory. So you did not sell it. If you did not sell it, there is a possibility you might return it back. If you are going to return it back, that means 50% of this 15,000 is unconfirmed profit. I'll repeat, 50% of this 50% of 15,000 for profit is unconfirmed. So when we were preparing the investment account, we actually added the proportionate share of the profit, right? So we took the entire profit, but that's not right. Why? Because half of this profit, half of 15,000 profit is unconfirmed. So half of 15,000 into my stake, this much amount of profit, what we will do, we will reduce it. The investor must reduce its equity by the proportion of unconfirmed profit. Understood, everyone? Only when the investor is going to sell this inventory, then you can recognize. Otherwise, you cannot. Simple. So normally what we did, normally we took our initial investment plus C. I will share you exactly how did we find investment. This is what we are discussing, investment in associate, right? So when I do my investment in associate, that is 20 to 50 percentage, correct? In this case, In this case, how do we calculate investment value? My investment value will be the beginning investment value, right? This is plus net income of the investee into the percentage proportion minus the dividend into the percentage proportion, right? Because dividend is going to reduce my investment account. This is how I will get my ending investment value, correct? Right? Now, in this case, what we are trying to understand is that while we calculate the ending investment value, only we should take net income that is confirmed. Only confirmed net income means that net income which is not confirmed, which happens in the case of upstream or downstream, that should not be taken, or that should be subtracted from the calculation. Understood this point, everyone? Same way in downstream. In downstream, the investor has recognized all of the profits in its income statement, right? Like upstream, the investor must eliminate the proportionate share of the profit that is unconfirmed. Same way. So whether the investee sells to investor or the investor sells to investee, in both the cases, you should eliminate this. So they've given the example, again, 30% of investee. During the year, investor sold 40,000 of goods to investee for 50,000. So investor's profit is how much? 10,000, correct? Right. Investee sold 90% of the goods. So 10% of the goods are remaining. So 10% of my 10,000 profit, that is 1,000, correct? That 10% profit of 10%, 10% profit of 10,000, that is unconfirmed. So guys, 10,000 was the profit, of that 10% is unconfirmed. And how much is my stake? My stake is 30%. So eventually the amount is 300. $300 of the profit. What should I do? This I should reduce. So my investment account, investor must reduce its equity income by this proportion. So 10,000 was the total profit. On that, 10% is unconfirmed and my stake was 30%. That goes to $300, should be eliminated or should be reduced. Only when the investee sells this inventory, then you can recognize this profit. Otherwise, you cannot. This is how you do, whether it's upstream or downstream. Understood, everyone? Clear, 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 clear. Okay. Now, the last thing in respect to investment in associate is how and what do the analyst faces issue. Okay. So when investee is profitable, what happens during that time? When the investee is profitable, investee is profitable means the company where you've invested, that is a profitable, and its dividend payout is less than 100%. Good thing or a bad thing? Let me see, I have a question, but this profit on downstream will not affect investment in associate. See, the question is the profit on the investee. I have a question. Profit on downstream will not affect investment in associate. See, my investment in associate might not be affected, but my equity income will be reflected. Yes. So in upstream, my investment account will be adjusted. In downstream, my investment account might not be adjusted, but the equity account. So see here, investor must reduce its equity income by the proportionate share here. And in the upstream, investor must reduce its equity by the proportionate amount. So ideally, in both the case, see, your investment is also going to be eventually the net income and everything is going to be part of your equity, right? So all of these will be eventually be if affected in the equity account. Understood, everyone? So in both the cases, the effect will be on the equity only eventually. Clear? So in both the cases, the effect will be on equity, just that we are now adjusting for the unconfirmed amount. Okay, so we are readjusting it. Otherwise, the effect is both in both the cases in the equity account. Right? Okay. Now, first of all, if you see carefully the formula, The more and more your investee makes the net income, what will happen? Your investment value increases. Assuming not 100% is paid out as dividend. Because if 100% is paid out as dividend, there is no change. So when the investee is profitable and dividend payout is less than 100%, the equity method usually results in higher earning as compared to accounting method used for minority passive investments. What is minority passive investments? Where your investment is less than 20%. So whenever your investments are profitable, it is sensible to use considered investment in associate and use the equity method, because what happens in this case is that you're going to add the proportionate share of net income along with your own net income. Thus, the analyst should consider if the equity method is appropriate. So companies are very much tempted to use equity method and show higher net income. So even if with lower stake or no influence, they might say that, oh, they do have an influence, and therefore they might approve themselves or using the equity method. So as an analyst, my job is to make sure that does the company deserve to have equity method or not. For example, investor could use the equity method in order to report proportionate share when it cannot actually influence the investee. So I need to check whether you can influence the investor or not. If you cannot, then you can't use the equity method. Understood, everyone? Second, also if the investee's individual assets and liabilities are not reported on the investor's balance sheet, means, see, one very important thing. What are we only taking from the investee in our equity account? We are only taking the proportionate share, right? Correct. The investor simply reports its proportionate share of investee's equity. So we just take the proportionate share of equity. We ignore the liabilities of the investee. So indirectly, we are ignoring the risk of the investee, isn't it? So we are ignoring the debt, the leverage, and all other risks that the investee might face. So by just taking the proportionate share of equity, we are ignoring other things about the investee, especially about the leverage. This is another issue. Okay, so as an analyst, I need to first check whether the influence is real or not. Whether the influence is real or not, this is first thing I need to check. Second, I also need to go through the investee's leverage, debt, and other aspect, because that is not considered when I just take the proportionate equity. I ignore the rest of the things. Understood? And then the last problem. Finally, the proportionate share of investee's earning is recognized in the investor's income statement. Correct? But the earnings may not be available to investor in the form of cash flows. Remember, the cash flow is only dividends. So even if you are recognizing the earning, is it cash? No, it is not cash. It is unrealized, because these earnings are not the profit that I have pulled out. They are my proportion of the net income. I have not pulled out that. So this, that is, the investee's earnings may be permanently reinvested. So guys, my what I'm doing, that the net income of that company, the proportionate net income of that company, I'm adding into my net income. Guys, my net income, I can declare dividends and use it. But the investee, what if that investee is going to reinvest that net income? So basically, a substantial portion of my net income from this investment might be illiquid. Well, we need to be aware about this aspect. Understood, everyone? Clear, 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 everyone? Have we covered everything till this? Yes. There was one aspect that we were supposed to discuss, and that was with respect to investment in associates, where we discussed how that investment reflects. Well, we use equity method, but there I think we missed out this part of fair value option. Remember, we use equity method only under IFRS. Under US GAAP, there is one more thing, allows equity method investment to be recorded at fair value. This is what US GAAP. US GAAP says only one method. Okay. But under IFRS, fair value option is only available to VC, mutual funds, and similar entities. So yes, US GAAP allows equity method to be recorded at fair value, but IFRS does not allow all the companies to report fair value. IFRS, the fair value option is only available to investment firms like VC and mutual funds. So only investment companies are allowed. The decision to use fair value option is irrevocable and any changes in the value are recorded in the income statement. So first of all, when you report this fair value option under the fair value option, in this case, US GAAP allows, IFRS allows only for investment companies. And if you use this method, it is irrevocable. Understood? This is one thing that we just missed out. Okay. Now coming back here. Okay. Yes. So what we were discussing the issues that the analyst faces with respect to investment in associates, especially we need to identify whether the influence is real or not. Okay. The second issue is that we are only considering the investee's equity proportion. So we are ignoring the debt and the leverage and the risk associated with that. So this is the second thing. And the third thing is that here we are recognizing the proportionate share of the earnings of the investee. Correct? But those earnings are illiquid. They might not be available for me because what if those earnings are reinvested? Clear, everyone? This is what we do under equity method. Well, there is another method also which we are going to discuss now in detail, that is called the acquisition method. Acquisition method where we acquire all, as the name suggests, acquisition method is where all the assets, liabilities, and revenue and expenses of the subsidiary are consolidated or combined with the parent. Have you heard about consolidated financial statement? Where all the asset, liability, income, expenses, everything is merged of the entity where you have invested. Correct? Correct? Intercompany transactions are excluded in case where the parent owns less than 100%. This is what we do if it's 100%. But if there is less than 100%, then the proportion that the parent does not own, what do we call it as? We call it as non-controlling or minority interest. Everyone, right? So the proportion that is not controlled, that minority interest for the proportion of the share of the subsidiary's net assets are not owned by the parent. This is another method which is called the acquisition method. Until now, we were doing equity method. Now we will focus on what is acquisition method. Remember, acquisition method is a different method where we are going to combine all of the assets, liabilities, income, and expenses of the investing company, assuming we 100% own it, but the proportion of equity that we don't own, that is reflected as a single adjustment called minority interest, which I will show you in a moment when we go to the third point of business combination. We've done investment in financial asset, investment in associate. Now you will see when you go to business combination, what exactly acquisition method is. This is the third part of the topic, business combination. Now we are moving to business combination. Business combination is when you are going to acquire another company. You are going to merge that company with you. Understood, everyone? Till this point? Okay. Now, let me show you how business combination works. It's a very interesting thing. There are two methods until now. We've discussed equity method, but now you will see what happens in acquisition method. Acquisition method is slightly different than equity method, but it's more like a consolidated method. Correct? We will see acquisition method in a moment. That is called business combination. Everyone all set? Right? Right? Okay. So let's start business combination. Now, for IFRS, business combination is when two companies come together, right? When one company acquires another company or when they merge, then IFRS does not differentiate it between how they come together. But US GAAP has a very interesting classification of business combination. See this merger. What is merger? So when guys, A company takes over B company after merger, does the B company exist? after merger, does the B company exist? No. After merger, only A company exists because A has taken over what? Taken over the B company. But in acquisition, so in merger, the target company or the investee ceases to exist, right? But in acquisition, both companies can continue to exist under the parent subsidiary relationship. Yes, so here under the acquisition, when A and B come together, so they both can be continuing individually. That is what is possible in acquisition. This is generally done when there is less than 100% of the subsidiaries being taken, means you have a 70, 80, 90% stake. Third is consolidation, where two companies merge together, they cease to exist and they form a new entity altogether. So altogether, after the merger, A and B cease to exist and maybe a new company called AP comes into the picture. Understood? This definition is only as per US GAAP. IFRS does not believe in this definition. Correct. Now, whichever type of business combination it is, right? There are two methods for this business combination that we are going to use. One is the purchase method, and second is the pooling of interest method, which now is not acceptable. It is now eliminated from IFRS and US GAAP. So we are going to use the acquisition method, which is now required. So now the acquisition method is required. So number one, we are going to focus on acquisition method and the purchase method. Purchase method basically is similar to the acquisition method. We are going to see what exactly acquisition method is. Your focus should be on acquisition and equity method. Later on, I will show you there is another method also, but focus now will be on purchase method or acquisition method. We are going to focus only on this method. It's one and the same thing. So we are going to call it as acquisition method. Acquisition method is often referred to as consolidation. So even when you see Apple's financial statement, it's consolidated. That consolidation is called acquisition method. Let me show you how acquisition method looks like. So suppose that on January 1st, 23, P acquires 80% of S by paying 8,000 in cash. So the pre-acquisition balance sheet is given to us. The first thing is pre-acquisition balance sheet. Correct? Correct. This is my pre-acquisition company P, who's going to take over company S. How much? 80% of company S. So guys, individual balance sheet of the company is being provided to us. So this is where our focus will be first on the balance sheet point. Okay. Now, what will be the changes after the acquisition? Now, first, we need to know that we will compare the equity method that we did in the past and the acquisition method. So under equity method, company P will do what? Company P will report 80% interest in the company S in a single line investment account. So only 80% of company S is equity. How much is company S equity? See, common stock and retained earnings are equity, right? So this is total how much? 10,000. So guys, what I'm going to do, if I had done equity method of accounting, under equity method, company P will have company P's financial information only, and of company S, just one adjustment that they will do is that they will take 80% of this 10,000. So see what happens in the equity method. In equity method, you will see all the numbers of company P only except investment in S of 8,000. 8,000 is 80% of 10,000. Understood, everyone? But you will notice that company P's current assets were how much? 48,000. Those current assets have been reduced by 8,000. Why? Can someone tell me why? Because 48,000 was the current asset and minus 8,000 is the cash paid, isn't it? So that's a cash outflow for paying to acquire the company, isn't it? Isn't it? Isn't it, everyone? So that's the only change. Rest all you will see is exactly as it is. 40, 28, 12. You will see everything exactly it is. 40, 28, 12, 32. That is how it will be. So under equity method, there is only one change, that we take the proportionate equity of S, and the amount that we are going to pay, that is adjusted from the cash. Everyone with me under the equity method? Everyone understood the equity method? Confirm, please. Check, 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 check. Understood the equity method, right? Only one adjustment we do is that we add this category investment in the subsidiary or that company, and the cash is reduced. Clear? Anyone doubt with equity method? Right? Now let us focus on acquisition method. Under acquisition method, we are going to combine, assuming we are going to take 100% of the company, right? But the 20% that we don't take, we will record it as a minority interest. So see this. Under the acquisition method, the assets and liability of both the company are combined. Combined. Both the companies are combined, and stockholders' equity of company S is ignored. Why? Because I'm going to take over the entire company's S stock, right? It is also necessary to create a minority interest for the proportion of equity not owned. Correct? So see this. What I'm going to do, 48 plus 16 minus 8. How much is 48 plus 16? Both the companies minus 8, the cash I'm going to pay. So check it. Does it match up to 56? 48 plus 16 minus 8, that will give you 56. Is it? Confirm, right? Rest all you will see other assets, 32 plus 8, 40. Current liabilities, 40 plus 14, 54. Correct? And 20% of the equity that we do not own, 20% of 10,000 that we do not own, is considered as a minority interest. Everyone with me? Correct? Correct, correct. See, minority interest is sometimes recorded under the liability, and some companies, some financial statement, you will also see it is recorded in the on the asset side, but negatively. So either it can be on the asset side negatively, or it is recorded in the liability side. Both will have the same effect. Correct? And now you will see the common stock is only of the acquirer, right? The target's common stock no more exists. Clear? This you will have to now analyze what happens. Where is the company's asset values higher? Under acquisition method or equity method? The company's assets value are higher under acquisition method. Am I correct? Yes or no? Everyone clear? Post acquisition, company P's current assets are lower by 8,000, used to acquire 80%, that we've discussed. But guys, under acquisition method, current assets are higher, isn't it? Correct, correct, correct. With equity method, current assets are 40,000. You will see the difference there, isn't it? So which method is beneficial if you want to show bigger assets and liabilities, bigger value of your company? If that is the case, then you prefer using the acquisition method. Acquisition method is where you consolidate everything, right? You combine everything, and only minority interest is shown for the part that you don't own. Right? Everyone understood? Clear? When using the acquisition method, company P reports 100% of the companies as assets, assuming that I own 100%, but the remaining 20% is what we show as minority interest. Correct? Correct, everyone? Right? That's what we did. Clear? Now we will see how the income statement is reflected using both the methods. So using the acquisition method and using the equity method, what will happen to the income statement? Remember, in acquisition method, you are going to combine, okay? And the proportion that you don't own, you show it as minority interest. So what will happen in acquisition method? You will take the net income of both, 20 plus 4. You will take 24,000. correct? But the proportion of the net income that you don't own, that is 20% of 4,000, will be recorded separately as minority interest. But under the equity method, it's pretty much simpler. You will take your earnings of 20,000, correct? Right, everyone? So what will I do is that I will take my earnings, and then if you notice, only 3,200, that is only 80% of that company's earnings is what I've taken. So this is 3,200. How did I get 3,200? It is 80% of the investees proportion. Investees earnings proportion is what I've taken into consideration. Now, overall, you will see where is higher revenue recorded. Under acquisition method or under equity method, where do you see higher revenue? Well, you will see higher revenue, higher expenses under the acquisition method. But the interesting thing is that the net income under both the method is the same, isn't it? Isn't it? The net income under both the method is same. Correct, 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 correct. So the minority interest we discussed, what will happen? Notice that the acquisition method results in higher revenue and expenses, but the net income is the same. This is the most important thing. Whichever method you use, the net income is always the same. Clear? Let us do question related to this, everyone. Company M acquired 20% of the company N for 6 million. So guys, anything between 20 and 50% is investment in? Yes, what is this called as? Investment in, everyone? Associate, am I correct? Less than 20% is financial asset, right? So 20% for 6 million. Company ends debt and equities are publicly traded. Okay. Company ends reported the following year end. Okay. Net income is given to me. Dividend is given to me. Net income is, by the way, a loss. If company M can significantly influence, that's why we understood or assumed it as investment in associate. What is the balance sheet carrying value of the company M's investment account? Everyone can tell me what will be the balance sheet value. Initially, it was 6 million plus how much proportion of net income, guys? 20% of 450,000, that is 90,000. But guys, 90,000 will be negative because it's a loss. Am I correct? Correct, correct, correct. And cash dividend 600 into 20, that is 120,000 dividend, 20% of 600,000. This will be my balance. So 600,000 minus 90 minus 120, that is going to be, yes, 6 million. Sorry, my mistake. It's 6 million, not 600,000. 6 million. Sorry. So 6 million. 1, 2, 3, 4, 5, 6 minus 210. I will get 5790. A is the answer, everyone. Check, 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 check. Clear, clear, clear. A, easy. If company M can significantly influence N, what amount of income should company M recognize? Very easy. We've already calculated is the net income that I will recognize is minus 90,000. Oh, sorry. Net income company M recognized from its investment for the current year. So 450,000, right? We've already calculated minus 90,000. How did I get this minus 90,000? 20% of 450,000. So that is already we have calculated. A is the answer. No doubt in this. Easy, correct? Right? It's the same thing. Now we are going to see the second situation. Selected operating result from Lowdown Inc. Okay, Lowdown Inc. in 22 and 23. Sales, revenue, everything is given. Martha Patterson, an analyst, okay, has been signed the task of separating Lowdown's operating and investment results. Now, operating, sales and operating is fine. See, the investment income is this. She intends to do this by removing the effect of returns on Lowdown's marketable securities portfolio and forecasting operating income for 2024. This is 22 and 2023. So guys, can you tell me what will be the adjusted operating income pre-tax? Operating income, what will be adjusted pre-tax operating income of 2022 and 2023? Can you please tell me? Yes. What will be the adjusted one? See, your operating income had this 45, which was from investment in 2022, and 160 in 2023. So what if we remove that from our pre-tax operating income? So 545 minus 45, this will be 500, and 660 minus 160 income, I will remove it. Again, this is also 500, isn't it? Correct? Right? We adjusted it. How did I adjust it? I remove the non-operating, that is investment income, because that's what she's expecting to do, right? Patterson assumes that the growth trend in operating income from 22 to 23 will be continued. Guys, I see the growth here is 0%, isn't it? So what will be my operating income in the next year also? They are asking what is going to be the operating income in 2024. What will be the answer, everyone? If the growth rate is 0, then very easy. The answer will be A only, 500 only. Am I correct? Clear, 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 clear. Everyone? Yes. Okay. Now we did this investment in associate. Now we are going to do question related to business combination. Business combination. Okay. Yes. Suppose company P acquires 80% of common stock of S by paying 120,000 cash. The two firms pre-acquisition balance sheet is given to us and income statement is provided to us. So we have the pre-acquisition balance sheet here of both the companies, and income statement is also provided to us for P and S. Understood? Very interesting. 80% you are going to take over the company S by paying 120,000 cash. Immediately after the acquisition, its consolidated balance sheet, company P will report total asset. Now see, when you consolidate it both, what will be your total asset? Your total asset will be equal to asset of your company, which is how much? 1.2 million and 360,000. So I will do 1.2 million plus 360,000, correct? Under the acquisition method, this will be the case, but you are going to also adjust for something. Can you tell me what something I'm going to adjust? My asset value will reduce by the cash that I'm going to pay. I'm going to pay 120,000 cash. So that will lower down my asset, isn't it? So minus 120,000 of cash that you are going to pay. Yes. So your total asset will be 1.2 million plus 0.36 million minus 0.12 million. That is going to be 1.44 million. Am I correct, everyone? Everyone? Check, check, check. What did I do? I combined both the assets, but subtracted the cash that I'm going to pay. Isn't it? The cash paid. Clear, clear. For the year ended, company P's pro forma consolidated net income. Consolidated net income, net income, net income. Also, you will combine both the net income. Correct, correct, correct. Will there be anything adjusted from the net income? What did we do here? Did we take the entire net income? See, check here. When we were doing net income, what did we do in the acquisition method? We adjusted for the minority interest, isn't it? So what can I also do here, guys? I will take my net income. First, I will combine the net income. So my net income will be 300,000 plus 60,000 minus the 20% that I don't own of the company, 20% of 60,000. So minus I will do 20% of 60,000 that I don't own. Okay. So basically I have to take only 80% of 60,000. So that is 48, isn't it? So that is going to be 348,000. Clear? Everyone with me on this? Confirm, please. Clear, 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 clear. Everyone? The non-controlling, which we don't own, we need to subtract that. Correct? Okay. Next, on December 31st, pro forma consolidated balance sheet, company P should report a minority ownership interest of Everyone, minority ownership interest of. Can you try this? Company P should report a minority ownership interest of. Okay. Yes. See, this is at the end of the year. What should be the minority interest? Check out this initially. Initially, when we invested, how much did we invest? We invested 120,000 is the cash we paid. Correct? 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 Okay. Now, remember the initial amount that you had invested, the beginning minority interest, and you want to know what should be the minority interest at the end. Okay. So, what are we going to do here? Hello, everyone. Yes. Can you tell me how should we start this? Yes, I will leave it to the class. Please try this. Everyone, there is no goodwill or anything. On December 31st, pro forma consolidated balance sheet, company P should report a minority ownership interest. P will report a minority ownership interest. See, minority is the proportion that you don't own. Okay. So, what is the proportion that we don't own? What is the proportion that we don't own of the company S? Everyone, see, check out the total equity value is how much, everyone in the class? The total equity value of S was 150,000, 90 plus 60. Of that, 20% that we don't own was the minority interest. So minority interest is 20% of 150,000 equity of the investee company that we don't own. So which is equal to how much? That is equal to 30,000, correct? But that was the initial equity from the last year, right? Before the merger or before the acquisition. Then we need to adjust for net income and dividend in the same way that we've been doing. So plus I will adjust for net income minus for any dividend. So how much proportion of net income should I take from company S? From companies S, 60,000, 20% of 60,000. That proportion I will take. So 60,000 into 20%, that proportion of net income I will add, which is 12,000, correct? And dividend of 15,000. So 15,000 dividend into 0.2, 20%, that we will subtract. So this is going to be around 3,000. So this will be subtracted and that will be my ending value of my investments. Understood? So that is going to be 39,000. Isn't it, everyone? Understood this point? Check, 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 check. Clear, clear, clear till this point, everyone? Everyone? Yes. Very, very interesting business combination where we are now using acquisition method, where we are combining the company's financial statements and whatever we don't own, that we report it as a minority interest. Understood this? Until now, we've done no adjustment of goodwill. The later part will have the goodwill adjustment and impairment related to goodwill also. Everyone clear till this point? Check, check, check. Correct? Right. Okay. So we are now going to understand about goodwill. Now remember, goodwill is the extra amount paid over and above the fair value of the assets, right? Correct. Goodwill is said to be the unidentifiable asset and it cannot be separated from the business, right? Under US GAAP and IFRS, there is a different treatment with regards to goodwill and there is a different rule. But before I make you understand that what is the condition of, what is the calculation method, there are actually two different ways also. Under US GAAP, goodwill is the amount by which fair value of the subsidiary is greater than the fair value of the subsidiary's identifiable net assets. Means, let's say the subsidiary's fair value is 100,000 and the fair value, the net asset value of the net asset value of the subsidiary is 80,000. So the extra 20,000 That is what we call as the goodwill under US GAAP. Well, this is what we call as full goodwill. This is quite different from what we do in IFRS. Under IFRS, goodwill is the excess of the purchase price over the fair value. So normally goodwill, what we calculate it is as per IFRS. US GAAP has a different method. Okay. So the method used by IFRS is called partial goodwill. So US GAAP wants us to follow the full goodwill. IFRS partial goodwill, but IFRS also being more flexible permits the use of full goodwill. Okay, so I am going to discuss now what is full goodwill and what is partial goodwill, and we will also write it down because that's quite critical. So, what is full goodwill and what is partial goodwill? I'll write down on a new page. First of all, remember IFRS US GAAP wants us to use this method only. So, goodwill, under the goodwill, we will discuss full goodwill and partial goodwill. Full goodwill and partial goodwill. Okay. Full goodwill is required under US GAAP. Okay. IFRS allows both full goodwill also and partial goodwill. Okay. So IFRS, I will say this is one is full goodwill is required under US GAAP. IFRS allows both. IFRS allows partial goodwill also. Okay. Allows partial and full goodwill. Full goodwill also. So generally used by IFRS. So I'll write down used by IFRS. Used under IFRS. Clear everyone? Correct. This is what is required as per US GAAP. Now we will understand the formula of both. Now, generally, the goodwill method that we all have seen is actually IFRS because IFRS method is the most common method. Most of the global companies use IFRS method. US method, US GAAP method is slightly trickier. Okay. So, first, I will discuss the IFRS method because in IFRS, we compare the purchase price. Okay, this the partial goodwill method. This is where we actually calculate the difference between the purchase price minus the fair value of the net asset of the target company. So minus the fair value of net assets of the subsidiary, net assets of the target company or subsidiary. This is what the general method we use for goodwill, but that is partial goodwill, that is as per IFRS. US GAAP uses full goodwill, which IFRS allows, by the way. Under full goodwill, how is the goodwill calculated? Very interesting thing. Under the full goodwill, we take the purchase price and divide it by the percentage of stake. So that gives us the full value of the company, the subsidiary's full value, right? That's why it's called full goodwill. So here the fair value of the subsidiary, right? We take the fair value of subsidiary. Now, what is the fair value? Fair value of the subsidiary is actually compared to the fair value of its identifiable net assets. So the difference is the same, minus fair value of identifiable net asset of subsidiary. Now, when I say fair value of subsidiary, what exactly is fair value of subsidiary? So the amount that you're going to pay for that company that you're going to take over, right? The purchase price per divided by the ownership stake. So this is equal to purchase price divided by the percentage stake, divided by the percentage stake or ownership. This is what I write the formula. They write slightly different. Don't worry. You will be able to solve in either case, and I will show you how both things are different, right? So I've written the goodwill formula. Now see how exactly this is done. Full goodwill, partial goodwill, A, B. Now instead of this, I'll directly go to the question and make you understand so that the formula is need not be memorized. Wood Corporation paid 600 million for all of the outstanding stock. Now, guys, the full and partial goodwill issue will come when you're going to not take all stake, right? So first we will try to understand how exactly goodwill comes into the picture. So you are going to pay 600 million for all the stock of the company, right? At the acquisition date, Pine reported the following condensed balance sheet. Now, this is the subsidiary's balance sheet, current asset, plant, and equipment. Guys, the balance sheet already has goodwill. We don't take this into consideration. You need to ignore it. Correct? Liabilities and stockholders' equity. Right? Okay. So my total asset, I need to take only this. Liability, I will only take this. So my fair value of net assets will be 800 plus 760 minus 400, but there are some adjustment also. The fair value of the plant and equipment was 120 million more than its recorded book value. So I will take 80 plus 760 plus 120. They said it should be more, right? Correct. Minus 400. Rest all was the same. Calculate the amount of goodwill. So guys, based on this, we will calculate the amount of goodwill now. 80 plus 760 plus 120 minus 400. The fair value of the net asset of the company is 560, but we paid 600 million. So that 40 is what we call as our accounting goodwill, or the goodwill, that is what is going to be reported. This is as per the acquisition method, what exactly the goodwill is. So this is the goodwill, right? As of now, correct? Everyone, right? Now we are going to understand what is full goodwill and partial goodwill. We calculated the goodwill, but how it is reported under US GAAP and IFRS. So full goodwill, which is allowed by both, and partial goodwill only IFRS. So I'll write down only IFRS, and this is recognized by both. Okay. Now see how the amount differs, whether it's full goodwill or partial goodwill. Remember here, the goodwill that you got 40 million is actually the full goodwill. So if you see the formula, how much was the purchase price we paid? 600 million for what was the stake? For the stake of 100%, right? Now see this. Continuing the previous example, suppose that Wood paid 450 million for 75 percentage. So 450 for 75, 450 for 75. So under the full goodwill, I require the fair value of the subsidiary. So what will be the fair value of the subsidiary? It will be 450 divided by 75 percentage, which is the 600 million, isn't it? Minus the fair value of the company's net assets, which, by the way, fair value of the company's net assets, calculate the amount of goodwill the company should report. So the fair value of identifiable net asset, which we just got it. What is the fair value of the identifiable net assets, everyone in the class? Yes, everyone. So excess of the amount. So under the full value method, we are going to compare two things: fair value of the subsidiary minus the fair value of identifiable net asset, which is 40 million. Isn't it? Isn't it? Isn't it, everyone? So what will be my amount of goodwill? My amount of goodwill we've already determined, that is 40 million, correct? So this excess value, see this, Wood's balance sheet goodwill is the excess of the fair value of the subsidiary, that is 450 divided by 600 million over the fair value of the identifiable net asset, which we just calculated was 40 million. So this 40 million that we derived here based on the value that we paid, this is nothing but this is our full goodwill. But remember, this is as per US GAAP, correct? As per IFRS, we need two things. What are the two things we need? We need to see what is the purchase price minus the fair value of the net asset. So fair value of the net asset we already got was 560, right? So here 600 minus 560 was pretty much simple. So here we did 600 minus 560, we got 40. But here in the second case, how much did we pay? We paid them 450. So here in this case, I have to do 450 minus the fair value of the net asset, but proportionate fair value of the net asset. That is 560 into 0.75. Right? So what happens in the fair value of the net assets of the subsidiary? The minor difference that you will see here is the proportion owned. So in my formula here, the difference that I need to do is the percentage owned. This is where slightly different the valuation will be, everyone. So my fair value of 560 into the proportion that I own, that is 0.75, that will be different, slightly different. That will turn up to be 30 million. So what I did is that how much I paid and how much is the proportionate fair value. Now I'm not taking 100%. I'm taking 75%. So I cannot take the 100% value. Understood, everyone? This difference clear? So now if you can see, the formula is complete. So here the normal goodwill that you calculate is called the full goodwill. But if you're going to take partial goodwill, you will only focus on the purchase price. Purchase price is considered in this case, and of course in the other case also, but here purchase price minus the proportionate fair value of the net assets. Correct? Now mathematically, if you see, the answer is different, and actually the goodwill is higher under full goodwill method compared to partial goodwill. Visible, everyone? So the balance sheet value will be higher under the full goodwill, isn't it? So goodwill is lower under the partial goodwill method, everyone, right? The value of non-controlling interest also depends on which method is used. If full goodwill method is used, full goodwill, the non-controlling interest is based on acquired company's fair value. Now, what do you mean by this, everyone? If you use the full goodwill method, you are considering the full amount of goodwill here, not the proportionate. Then in this case, again, whenever you take the full value, you have to reflect the non-controlling interest or minority interest, right? If partial goodwill method is used, non-controlling interest is based on the fair value of the acquired identifiable net assets. Now, this is a bit confusing. So what I will do is that I will show you exactly what do they mean by it. So what is non-controlling interest? The proportion that you do not own, isn't it? So the proportion not owned into the full price of the company, and here the proportion not owned into the fair value of net assets. So if you see, the amount will also be different, because here if I do non-controlling interest under the full goodwill method, what will happen? What was the purchase price? What was the full value of the company? It was 600, right? 600 into proportion not owned. 75% I'm going to own, right? So 600 into 0.25. Correct? This is the proportion that I do not own. So that is 150, isn't it? Correct? So 150 million will be my non-controlling interest under the full method, right? But under the partial goodwill, non-controlling interest is again 20% of the fair value of the net assets. Remember here, non-controlling interest under the partial method. We did under the full method. Now under the partial method, I will focus on the net asset value. The net asset value of the subsidiary is how much, guys? 560. So 560 into 0.25. If you see this 560 into 0.25, that is going to be 140. So here my non-controlling interest is also lower compared to non-controlling interest of 150 million here. Everyone understood the difference? Clear? So if I want to calculate my non-controlling interest, here my non-controlling interest in this case and non-controlling interest in the other case. Non-controlling interest in this case. In this case, my non-controlling interest is this into the percentage not owned. So my non-controlling interest is this times the percentage not owned. Here my non-controlling interest is fair value of net assets. So I will say fair value of net assets of subsidiary, correct? Into the percentage not owned. Clear, everyone? That is how the non-controlling interest is calculated under both the methods, isn't it? Overall, you will see the full goodwill method results in higher total assets and higher total equity because the non-controlling interest is relatively higher, right? And now, guys, if the assets value are higher, and if the asset value is higher, the two ratios, the return on asset and return on equity will be lower. So what is the effect of it? That the profitability in terms of percentage will look lower. So if you are using full goodwill method, guys, your ROA and ROE will be lower because of the higher value of your asset or equity. Understood? Right? Rest of the thing about goodwill, we already know goodwill is not amortized but tested for impairment at least annually. And there's a difference of treatment under IFRS. There's a different rule of impairment, and US GAAP has a different rule of impairment. Both of the impairment related adjustment, I will show you it in a moment. But remember, whenever you impair in the future, the value of asset, when it goes up, can I reverse it? Once it is determined that goodwill is impaired, the loss is recognized. Okay, that is fine. The impairment loss is recognized in the income statement. Correct? Now, this is what we do whenever we recognize the goodwill impairment. Impairment, remember, is like a loss. Now, the impairment condition and the impairment calculation is different under IFRS and under US GAAP. Under IFRS, it's a single step process. Under US GAAP, it's a two-step process. This is something that we did in level 1 also, but here we will do it again. So I will rewrite here that how to adjust for goodwill impairment. Goodwill impairment. So we will do goodwill impairment from the point of view of IFRS and US GAAP both. IFRS is single step method, US GAAP is a two-step method. So let me reflect both. Under IFRS, under US GAAP, this is more of related to your level 1. Okay. IFRS single step. Here, see, in IFRS, we are going to compare what? We are going to see that the value, the fair value, has it dropped below the carrying value or not. So here, the value that we focus here is called as the recoverable amount. So if the condition is, if the carrying value is greater than the recoverable amount, I'm writing it in short form here. You can also write it full form. Recoverable amount. Then we consider the asset is impaired, and the difference between the both is my impairment loss. So my impairment loss is the difference between the carrying value and the recoverable amount. This is a simple step under IFRS. So let me show you that here, everyone. In IFRS, the testing for impairment involves a single step. If the carrying value exceeds the recoverable amount, impairment loss is recognized. So let me show you here, everyone. Last year, parents company acquired sub for 1 million, correct? On the date of acquisition, the fair value of the net asset were 800,000. Okay, so the fair value was 800,000. So guys, can you tell me how much was the goodwill originally? Original goodwill was, everyone, 1 million minus 800,000. Original goodwill was 200,000. Am I correct, everyone? Check, 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 check. Thus, the parent reported a goodwill of 200,000 at the beginning. Nothing wrong with it, correct? At the end of the year, the fair value of the subsidiary was 950,000 and the fair value of the sub's net asset was 775,000. Now, guys, if I recalculated the goodwill right at the end of the year, they are saying the fair value of the subsidiary was 950, correct? But the fair value of its net asset was only 775,000. So how much was it extra? Everyone in the class? 950 minus 775. That is 175,000. Guys, what is this 175,000 called as? This 175,000 is called as implied goodwill. What is it called as? Implied goodwill. Let me discuss with you what is implied goodwill, everyone. Implied fair value of the goodwill is calculated the same manner. Thus, that is the fair value of the reporting unit is allocated to identifiable net assets if they were acquired on the measurement date. So assuming that if we acquire the business today, what will be the goodwill today? That is called implied fair value of the goodwill. Everyone understood this? So first, let me write down what is implied fair value of goodwill. Okay. So in the goodwill impairment, normally goodwill is the extra amount that you pay, correct? Right? So original goodwill was based on the amount that you paid over and above the fair value of the net assets. But implied goodwill, let me write down implied goodwill. Implied goodwill is equal to at acquisition date. Okay. At acquisition date, what are we supposed to do? The implied goodwill is always calculated at the acquisition date. It's again the comparison of what is the fair value of the subsidiary minus the fair value of the net assets, isn't it? So here we compared the two things for calculating the implied goodwill. We were given the fair value of the subsidiary, correct, minus the fair value of the net assets of the subsidiary at the acquisition date. At the acquisition date. This is called my implied goodwill. Normally, see, we calculate goodwill at the beginning, but what if after 1 year we recalculated the goodwill? Assume now we take over the company, what would be the goodwill? That is called implied goodwill. Okay, just for reference. Now, what is the use of this? So, assuming that the carrying value of the subsidiary is 980,000, determine if impairment exists and calculate the loss. First, I'm going to discuss with you the IFRS, which is a single step approach. So for IFRS, to identify whether goodwill is impaired or not, I need to compare two things. I need to compare the carrying value, which they've given me is how much, guys? 980,000 after a year. And the other thing that I'm going to compare is what? The fair value of the net assets of the company or fair value of the subsidiary. What exactly should I do? Well, I'm going to compare with the fair value. Actually, the word that we use is recoverable amount, which is nothing but the amount. Instead of recoverable amount, they don't use the recoverable amount. They use the word that today, if I sell off the company, how much will I get? That is the fair value. So that fair value is 950,000. That is the fair value, which is also called the recoverable amount here. So the difference between both 30,000 is my impairment loss. Since, first of all, will the impairment happen? Yes, because the carrying value is higher than the fair value. And the difference is my impairment loss. IFRS is pretty much simpler. Okay. US GAAP is a two-step process. First, you have to identify whether impairment will exist. And then second step is the calculation of the loss. Okay. So what happens in US GAAP? US GAAP goodwill impairment has two steps. First step, the carrying value of the reporting unit exceeds the fair value of the reporting unit, then an impairment exists. So two things we are going to compare. We are going to compare the carrying value and the recoverable amount, which is what we exactly did. 980 and 950,000. Correct? So here we are going to compare again. Step one, we are going to compare the carrying value if it is greater than the recoverable amount. Again, here the recoverable amount is nothing but the fair value. So I'm just writing it here as a note. Note, recoverable amount of subsidiary is nothing but the fair value of the subsidiary. Clear, everyone? So today, if I sell off the subsidiary, how much will I fetch? That is the recoverable amount, correct? Now, if this condition is agreeing, then you go ahead and step two and calculate then you calculate the impairment loss. But for impairment loss, you need to do something different, and that is where comes the implied goodwill. So what happens in impairment loss? See this. Once it is determined, this is my first step, right? Once it is determined that the goodwill is impaired, the loss is measured as the difference between the carrying value of the goodwill, which we, by the way, have here as the carrying value of the goodwill. Carrying value of the goodwill. Remember, the original value was of the goodwill was 200,000, correct? And they are asking me to compare the carrying value of the goodwill and the implied fair value of the goodwill. So what was the original goodwill, guys? The original goodwill was 200,000, correct? And then we got the implied goodwill as 175,000, isn't it? So the original goodwill of 200,000 and the implied goodwill of 175,000. Step number one, we compare whether the impairment exists or not. In step number two, we calculate the implied goodwill of 175,000, that is on the acquisition date, and compare it with the original carrying value of the goodwill, which was 200,000. The difference of 25,000 is recognized as an impairment loss. So in step number two, we compare two things: the original goodwill amount, which was 200,000 at the beginning, right? Correct. That is called the goodwill carrying value. So we now, the impairment loss in this case is the difference between two things. Two things what? Carrying value of goodwill minus implied value of goodwill. Everyone understood? Implied value of goodwill. And what is implied value of goodwill? That's what we calculated. It is assuming that you are recalculating goodwill after a year. So the difference between both, this is where the US GAAP differs. Understood, everyone? So my impairment loss under US GAAP will be 25,000, and under IFRS it is 30,000. Again, you will notice that the IFRS impairment loss is higher. Clear? Clear? Clear, everyone? Also remember, goodwill, first of all, only appears when you're going to pay more than the fair value of the net asset, right? But they are saying rarely does happen that you are going to pay less than the fair value. Now, when such things happen, both IFRS and US GAAP require that the difference, this is when you're going to pay less. First of all, it rarely happens unless and until the investee company is desperate, right? In this case, the difference between the fair value and the purchase price will be not a loss, but it will be recognized as a gain in the income statement. Otherwise, we would recognize that as in the balance sheet as goodwill. Here, if it is the opposite, we recognize as a gain in the income statement because that means you got the company at a lower price. Got it? See, check this. According to US GAAP, goodwill is considered impaired if, remember in US GAAP, for impairment, what was the test of impairment? Carrying value. You compare the carrying value with the fair value or the recoverable amount, and the carrying value should be greater than the fair value. Fair value or recoverable amount, both are the same thing. Understood? So implied goodwill at the measurement date, no, implied goodwill is step number two. First of all, we need to identify step number one. Carrying value of the reported unit is greater than the fair value. Nothing wrong with this. Goodwill can be separated. No, it cannot be separated from the business. Adam Corporation acquired Hardy, okay, using the acquisition method. Adam is preparing to report its year-end result, including Harry, according to IFRS, okay. Which of the following statement regarding goodwill is accurate? IFRS, single step method. Adam would amortize its goodwill. First of all, goodwill is never amortized. Adam would test goodwill annually to ensure carrying value is not greater than recoverable amount. This is fine. Adam would test goodwill annually to ensure fair value is not greater. No, no, no. Carrying value should not be greater than the fair value. If it is, then there is an impairment. So every year I'll check that. Understood, everyone? B is the answer. Clear, 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 everyone? Got it? Perfect. Yes. So we've done three part, that is investment in financial assets, investment in associates, and business combination. Business combination we did first without goodwill, considering goodwill, and now we did consider goodwill. Whenever there is goodwill, remember full goodwill and partial goodwill, full and partial. The normal goodwill that we calculate is actually the partial goodwill as per IFRS, correct? Full goodwill is where you take the fair value of the subsidiary minus the fair value of the net assets of the subsidiary. This is slightly tricky. This is the new thing. This is what we do as per the US GAAP, which is this method is compulsory under the US GAAP, right? Based on this, the non-controlling interest is calculated. Clear? Clear? And what is the goodwill impairment? Single step under IFRS, two-step process. First, you need to confirm whether there is impairment. For that, you compare the carrying value with the fair value. If yes, then you have to actually take the original goodwill, the initial goodwill, and the implied goodwill, and the difference between both is your impairment loss. Clear? Clear, everyone? Till this point? Okay. Now we are going to the fourth and the last type of investment structure, that is joint venture. Joint venture, here also we will use the equity method. Equity method, that is proportionate method. Under joint venture, what happens is that two companies have come together and they have a joint control. Okay. So recall that a joint venture in which a control is shared by two or more investors, they are created in various legal, operating, and accounting forms. Most of the times you do a joint venture when you want to temporarily do a project, okay, or you want to invest in a foreign market, special project, or risky venture, because you know this venture is not going to last forever. That's why you do a specific project for a limited period of time. When the project is shut, the joint venture is shut, right? So both US GAAP and IFRS require the equity method of accounting. However, in rare circumstances, we will use another method also, which is called as proportionate consolidation method. This may be allowed under both. So ideally, we use equity method. Equity method is required, but in some circumstances they allow you another method which we will discuss, proportionate consolidation. Consolidation is combining, but proportionate consolidation sounds very similar, right? Yes, it is similar to business acquisition, except that the investor only reports a proportionate share of the asset, liability, and expenses of the joint venture. So you're going to do proportionate asset. So you're going to take partial asset liability of the company, not 100%. Understood? Correct? Now, if you had taken 100%, then you show the remaining as minority interest. Now, since you are only taking proportionate share, no minority interest is needed if you do proportionate consolidation. Repeat, proportionate consolidation does not require minority interest. Clear, everyone? Right? Now they've taken the previous example only, right? Where company P acquired 80% of company S for 8,000, and we were given pre-acquisition, pre-acquisition balance sheet and income statement, right? Now they have given us the post-acquisition balance sheet year for proportionate consolidation and for equity method. Now, actually, it's better you also see the pre-acquisition, because by this time you must have forgotten the pre-acquisition. So what I'll do is that I'll go to the pre-acquisition numbers also. Where are the pre-acquisition numbers? See, where is the pre-acquisition number? Yes, P and S. See, this page. This page is the pre-acquisition number. This is where it is the pre-acquisition number. Everyone visible? Correct? Now company P is taking over company S. This is on page numbers after 7.5 business combination first point. Okay. Now guys, if you notice, they have given us the pre-acquisition information of P and S. Now we are going to do equity method and proportionate consolidation. In equity method, it is pretty much simple as what we had done. What we do is that we keep the P's information only and we take the proportionate or we take the proportionate share of the equity of the investee company. So S, what is the equity value of investee? 10,000. So 80% of S is what we took in as our investment in S. And the amount that we paid was adjusted from what? Was adjusted from the current asset, because that's where we paid the cash. So from 48,000, the cash paid was adjusted. So equity method there also you will see pretty much the same. But in proportionate consolidation, what I will do is that I will take my current asset and other asset and current liability, and I will take 80% of current and other assets. So what is 80% of current asset of company S? 16,000 into zero point 0.8. That is 12,800. That 12,800 plus 48,000 minus the cash paid, 8,000. That will be my current asset. So let me show you this in a moment. So highlighting this page, where were we? So see this in the proportionate one. How did I arrive to this 52,000, guys? See, there was 48,000 there, correct? Minus 8,000 cash paid and plus 80% of 16,000. That is the proportionate. This is how we got 52,800. So zero point 0.8 into 16,000, that is 12,800 plus 40,000. This is how you got 52,800. Correct? Rest all you will see the current asset, other asset. So apart from current asset, the other asset, you simply take the proportionate share of that company, right? Current liability and current stock. So let me show you what happens to current liability and current stock. So see, in case of other assets, we will take 32,000 as P and 80% of S. So 6,400 plus 32,000, you will see you will have their current asset of 38,400. Correct? When it comes to current liability also, we'll do the same thing. Here it is 40,000 and 80% of 14,000 plus 40,000. There you will see current liability of 51,200. But common stock will remain our common stock only. Why? Because we are going to take over that company. When we are taking proportionate share, we are only going to take over that company. So what will happen is that we've taken proportionate assets and liabilities, so we no more require minority interest. So you will see 28 and 12 as it is, and only the liability and asset will be proportionately changed. So you'll see 28 and 12 as it is, everyone. So what happens in the proportionate consolidation? You will see that the total of asset value is higher. Everyone with me? Correct? Correct. Total asset value is higher or not? Under proportionate consolidation, yes. Under proportionate consolidation, P's current asset we calculated. With that, P company reports 80% share, so no minority interest was required, and investee company's equity was ignored. Notice that proportionate consolidation results in higher assets and liabilities compared to the equity method. Everyone, right? But the net effect on the stockholders' equity is always the same. So the stockholders' equity doesn't make any difference. You see, before under this method and under this method, the stockholders' equity is exactly same. There's no difference. Clear? Only the total asset and liabilities look heavy. So the company's balance sheet looks heavy, but the total equity is always the same. With respect to income statement, also, you need to know for a fact that whichever method you use, the net income doesn't change. Only thing is that in the equity method, what we did is that we took the same thing here. We will consolidate the proportionate revenue. So there's no need of the minority part here. But in that case of equity method, we took the value of P only, and we took 80% of the net income of the subsidiary. Remember, the subsidiary's net income there was, I think, 4,000. So we took 80% of that. This is what we did in equity method. Let me just show you that. In equity method, the net income here was, how much was the net income? We have the balance sheet here. Yes, so we took 80% of this 4,000. That is what we did. In the proportionate consolidation, you no more need this because you are taking the net revenue, you are taking the proportionate revenue, proportionate cost. So you no more need to allocate it separately. The net income is always the same. Correct, correct, correct. No minority ownership is necessary. Notice that the proportional consolidation results in higher revenue and higher expenses, but the net income is always the same. Isn't it, everyone? Check, check, check. Correct. So actually, until now, you've done three methods: equity method, proportionate consolidation, and acquisition, where you combine both. Okay. You will see minority interest in combination or acquisition and also in equity, but there is no need of minority interest in proportionate consolidation. Yes. Using the following information, company C owns 50% interest in JV and accounts for its use of equity method. So we are going to use equity method, right? So we will have minor interest. Assets and liabilities have book value equal to their fair value. Okay. They've given us the result, company C, and we are going to hold 50% in the JVC. Okay. This is my balance sheet. This is my income statement, company C, and 50% of JVC. Clear? Okay. Yes. Assuming consolidation using the acquisition method, you're going to combine both the companies, right? Company C's stockholder equity. Guys, first of all, stockholders equity. When I combine both, what is going to be my stockholders equity? First of all, my equity will be my equity for company C. Okay, you're looking for company C. What is company C's equity initially, everyone? 5950 was the equity, correct? And how much proportion of JVC's equity is with me, everyone? JVC's overall equities, guys, how much? 80, 800, and 50% is my investment, right? So 50% of 800, that is 400 extra. So my answer will be, my equity amount will be 6350. Everyone with me on this? Understood? Can you try the second one? Assuming consolidation using acquisition method, correct? Company sees total asset at the end of 2024. Yes. Can you tell me what will be the total assets when you do the acquisition method? Everyone, acquisition method is where you will combine both, isn't it? Yes. What will be the total asset? Please tell me. Anyone? Remember, individually, the total assets are 13,450, 4,400. Yes, everyone. How much cash is paid? Company C owns 50%. Yes, anybody, somebody? What is going to be my answer? Total assets? Anybody? Okay, total asset will be, everyone, 13,450 of our company plus I will take the whole total assets of the JV and adjust for something. What is that something that I will adjust, guys? I will adjust for the minority interest, right? What is the minority interest? The 50% of 800. Am I correct? Right? Clear, everyone? See, check here. When we did the acquisition method, everyone, what we did is that we combined the total assets, everyone. Correct. So the total asset was combined, but what we did is that we adjusted for minority interest also. So minority interest needs to be adjusted, or you can probably consider is that the amount that you paid as cash. Correct. So that is what needs to was subtracted from the current asset, isn't it? Correct. So how much did you pay for the company? You paid $8,000 as cash in that case. Am I correct, everyone? So here, what we are going to do is that when we take the acquisition method, we took the total assets, and the number here were interesting. The total asset is what we did. We combined both the company's assets, isn't it? We consolidated both the assets, and along with that, we included our company assets and the JVC's full assets and removed the equity investment into that company. So that amount of equity that we invested, that is 50%, that is what we adjusted. Clear? So what is going to be your amount, everyone? 13,450 plus 4,400 minus my proportion of 400. So that is 17,450. Everyone with me? Correct? Yes. Next, assuming proportionate consolidation. Proportionate consolidation, everyone, right? Okay, company sees cost of goods sold and net income. Guys, proportionate consolidation, what I'm going to do, company C will do what? Company C will take proportionate COGS. So my COGS of 7,000 and I will take 50% of 2,000. Correct, everyone? So 7,000, my COGS will be 7,000. I will write down. My COGS will be 7,000 plus 50% of 2,000. That is what it will be, 8,000. Am I correct? So COGS has to be 8,000. But guys, net income, we just discussed without even calculation. We can say the net income under whichever method you use, the net income is always the same. So the net income has to be the same in whichever method you use. So the net income was 930, everyone in the class, right? 930 was my initial net income, right? Right. Will the net income differ whichever method I use? No, whichever method you use, net income of 930 is not affected by the proportionate consolidation method. So my net income will remain the same. Understood, everyone? Clear, clear. Right? Net income remains the same. Why? Because I take proportionate revenue, proportionate COGS, so the net income doesn't change. Clear? Yes. According to US GAAP, which of the following statements about the method used to account for JV where each party owned 50% is most accurate? Investor can choose between acquisition and equity method. No, that is IFRS. IFRS gives the choice. US GAAP is very strict. US GAAP says that I will allow you only one method, that is equity method, isn't it? So US GAAP requires equity method. It is IFRS which allows the other method. Is this clear, everyone? Understood, everyone, about joint venture? Correct, correct. Yes. Okay. Now, ideally, the topic is done when it comes to the four structures, but in some cases, we do special purpose entity structure also. Special purpose entity, remember in level one, you did securitization where you created a paper company where actually there is no employee, right? But you created this legal structure so you can isolate those loan portfolio or the assets, correct? Right? Also, that makes your borrowing much easier because it's a lean company. It doesn't have any other liability, right? So this SP can take any form. It can be a corporation, partnership, or even a joint venture. And in case of securitization, we call that SP as a trust, isn't it? So what is the real motivation behind this? First of all, to reduce risk or lower the cost of funding. That is what was the real purpose behind securitization also. But remember here, the entire control of the SPE is with the sponsor company, the one who owns it. That's why we call it as a paper company only, right? There is no employee or anyone, correct? So finances or operating activities, they are being controlled by the sponsorer, while third parties have controlling interest. So they have a proportionate stake in the company, right? Now, previously, these SPEs were maintained as off balance sheet, but after the financial market crisis, SPEs are no more off balance sheet because when you consolidate the financial statement, SPE's financial statement is also reflected in the parent company, right? Now, the FASB, that is the US GAAP, uses the term, don't call it SPE. They use a term called variable interest entity. This is what US GAAP does. US GAAP has a name for it, that is variable interest entity. So they don't use the word SP. IFRS doesn't have anything like that. IFRS considers SP. IFRS, it doesn't matter, right? But to be an SPE or variable entity, interest entity, you need to meet certain criteria. Either of the both you can have. First, at risk equity is insufficient, means alone that company cannot operate. It requires the support of the sponsor, right? And the equity investors of that SPE does not have voting right or decision making. They perhaps do not have the obligation to absorb expected loss or any right to expected returns. So basically, there are no shareholders of that company, right? The actual shareholder is the sponsor itself. So there is no additional voting rights. So when any of these two conditions are met, the US GAAP classifies that as variable interest entity. IFRS in this regards is quite flexible. Only US GAAP considers this variable interest entity. IFRS or IASB continues to use the term SPE, and the sponsoring entity must consolidate the financial report. So US GAAP has a criteria. IFRS does not have a name for it. US GAAP calls it as variable interest entity, and they also want it to be consolidated. So the sponsor should consolidate in both the case. In both the cases, we are going to use a consolidated report. So today, no more off balance sheet. Whether even if it is off, even if it's a separate entity, the consolidated financial statement will reflect that. So that escape route, which was there initially, is gone. Okay. So let me show you how exactly this works. Company P is a textile manufacturer wants to borrow 100 million, and it has two options. Either it can do itself or through a subsidiary. So number one, it will borrow directly from the bank. And the second is where P will create an SPE, and that SPE will borrow 100 million. So P doesn't borrow. So see, and for SPE to borrow on behalf of P, why would the SPE do that? There will be a transaction where P will sell off some of its receivables to the SPE, and based on that receivables, SPE will go and borrow. Remember, in the topic of securitization under fixed income, P, the bank, used to sell the loan portfolio, that is the assets, right? Though that's why we called it as asset-backed securities. Here, instead of loan, we are going to sell off our receivables. So what P will do, they will sell 100 million worth of receivables to S, and based on that collateral, SPE will go to the bank and borrow. Now, because SPE is a company which doesn't have any other debt on its book, then the SPE's credit rating is better. Correct? So what is the company P's balance sheet before borrowing is provided? They've given us the balance sheet here. Everyone, asset and liability. Now remember one thing, as soon as it will go for borrowing of 100 million, where will the changes be? Will there be changes in the cash? Yes, 100 million will come in, correct? And this is a form of borrowing. So if P borrows, its debt will also increase and its total asset will also increase, right? See this. So in case study one, in option one, if P borrows 100 million, so its cash has increased, its debt has increased, and so its total asset has increased. This is what will happen if P directly goes to borrow. But what if P goes through the second option, that is through the subsidiary? So then P is going to sell off its accounts receivable. So from 200, it will become 100. You see that? These accounts receivable are taken over by the by the SPE. So SPE will have an accounts receivable now of 100. Clear? Now, based on that SP, the SP will borrow 100 million from the bank, and because it bought the receivables from P, it will give cash to P for those accounts receivable. But see, P's debt hasn't increased. P got the cash by reducing the accounts receivable. So actually, P got access to funding without actually increasing its liability. Isn't it? Magic? You see that? Everyone? Clear? So P actually increased what? Its funding, its cash without actually increasing the debt. Clear? Everyone? So after consolidation, SP's debts get included in P's debt and accounts receivable for P increases by the same amount. Very interesting, isn't it? So company's P balance sheet before the SP was consolidated will not have those debt. However, as I said, after the financial crisis, because of the consolidation, the situation is same. So after consolidation, what will happen? If you see both companies, accounts receivable will be back at 200, debt will also be consolidated and cash will also be added. So the situation is exactly same whether P directly goes for borrowing itself or through the SPE. After consolidation, there is no more difference. Visible, everyone? After consolidation, yes, they have said company P cannot hide the borrowing of the books. Can you believe previously, before the financial crisis, this was both separate. So when you look at P's financial statement, you were like, wow, it's less leveraged. Understood? Such a big debacle. Can you believe it? Now, of course, they've forced it to be consolidated. Clear? Right? Okay. Now, guys, just before we have two things now. One is that there are some other issues that needs to be discussed during business combination. When you combine, there are some of the adjustments. What do we need to do about it? For example, companies may have contingent asset and liability. What is contingent asset and liability, guys? Contingent asset or liability, these are the liabilities or asset that may appear in the future. Right now, they are not existing. Now, IFRS and US GAAP, there is slight differentiation with respect to the adjustment. So I will also write it down. What is the adjustment needed to be done with respect to contingent asset and liability? There is some adjustment needed, and IFRS and US GAAP has a differential treatment. Okay. IFRS and US GAAP, they both have a differential treatment with respect to contingent liability and contingent assets. So for contingent liability and contingent asset, what is the treatment that I will have to show you, which is very unique and something that is based on the conservative principle. So contingent liability means something that I have to pay in the future, if not now. And contingent asset, how the treatment will be as per IFRS and US GAAP. Okay, let's see that. So under IFRS, only contingent liability whose fair value can be measured are recognized at the time of acquisition. So IFRS only asks you to recognize what contingent liability, because conservative accounting means that we have to pay. So what about contingent asset? Well, contingent asset is not recorded. Liability at fair value, contingent assets are not recognized. So I'll write down here under IFRS, contingent liability will be recorded at fair value. Contingent assets are not recognized. What is the reason? As I said, conservative accounting. So something that is expected as a benefit, no need to record it. Expected to be as an outflow, yes, record it at fair value. This is what IFRS says so. US GAAP, as usual, you know US GAAP is slightly tricky. Okay. First of all, they have said in the subsequent period, contingent liabilities are measured at higher of the value initially recognized or the best estimate of the amount needed to settle. So later on, you will revalue them. You will see whatever is the fair value means what? Every year you will check what is the fair value to be paid as on that date. If the value increases or decreases, accordingly, you will adjust it. This is what we do as per IFRS. Now, as per US GAAP, okay, US GAAP divides contingent asset and liability into contractual and non-contractual. Yes. So under US GAAP, what happens is first, US GAAP says, see, your contingent asset and liability, let me divide them into contractual and non-contractual. Okay. So US GAAP, the problem with US GAAP is that it overcomplicates things, right? It wants contingent asset and liability. Contingent asset and liability under US GAAP is either contractual or non-contractual. That needs to be first classified under the US GAAP structure. Understood? Now, what is to be done whether when it is contractual or non-contractual? Now, by the way, let me tell you, I've rarely seen any questions related to that or any doubts related to that in exam, but still we are just doing everything. Okay. So US GAAP wants them to be divided. Contractual contingent assets and liabilities are recorded at fair value on the acquisition date. So we will record based on fair value, both contractual, but only which one? Contractual assets and liabilities are recorded at fair value. Understood, everyone? Only contractual assets and liabilities are recorded at fair value. What about the non-contractual one? Non-contractual assets and liabilities are also recorded if more likely than not, they meet the definition of asset and liability. So they are also recorded if they meet the definition of asset and liability, right? Correct. So they are recorded if so I will write here contractual and non-contractual are recorded if what? If they meet the definition of, if they meet the definition of asset and liability, if they meet the definition of asset and liability. Okay. Now this is quite accounting, so I don't want to go into detail and trouble you. But if they meet the criteria of asset and liability, then you can record them. Otherwise, you cannot. So this is what we will record. And there is, by the way, treatment. What about the liability? See this, everyone, very interesting. Subsequently, measurement of contingent liabilities similar under IFRS, while contingent assets are recognized at lower of initial value and the best estimate of future settlements. So again, assets and liabilities. Liabilities is similar under IFRS, while assets are recognized lower of the original value or the fair value. Why? Because asset cannot be overvalued. So assets in the future, assets are recorded, contingent assets are recorded at lower of original value or fair value, I should say, lower of original value or the initial value, and the best estimate of the future settlement, that is the fair value. Clear? This is where it was slightly complicated. Now, this is what contingent asset and liability was. What is contingent consideration? Remember, in this case, we are going to acquire another company and we generally pay cash. But contingent consideration is sometimes you promise to pay the investee company some amount right now and some amount later if the target company performs well. For example, venture capitalists, when they invest in startup, right, they might have a participating benefit in the company. So what they might do, they might have additional benefit in the company when the company share price increases. Similarly, the ones who are taking the funding, right, they might also get some proportion of the benefit now, and they might get an additional compensation in the future. So if the acquirer has promised a contingent consideration to be paid to the investee, right, to the former shareholders of the subsidiary, correct? Such consideration is recognized at the fair value. Yes, under both IFRS and US GAAP. So whether it is asset, liability, or equity, it has to be recognized in whatever form you have promised the consideration, that additional consideration in case if the company meets the target, that has to be recognized at fair value. If there are any changes, that needs to be reflected in the income statement unless the value was originally classified in equity. So if it was already in the OCI or in equity, then fine. Otherwise, you need to recognize these changes in the income statement. All you need to know is contingent consideration needs to be recorded at fair value and any changes in the income statement. Now, what if there is in process research and development? Remember in level 1, we discussed research and development. Research is expense, development is capitalized. So suppose you are merging the two companies, and at that point, what is to be done with something which is an ongoing research and development? In this case, they are saying in process R&D is capitalized. So if it's still in process, capitalize, and capitalize as what? As intangible asset, and include as an asset under both IFRS and US GAAP. So number one thing, if there is any ongoing research and development, simply capitalize. But if there are any restructuring cost, expense. So any restructuring costs are expensed. Okay. So just remember two things. In process R&D, capitalize. Restructuring costs are temporary, so they are expensed. Clear? Finally, we'll see a summary of all four, and the summary of all the treatment that you saw, majorly equity method, acquisition method, and proportionate consolidation. Three methods that we saw. What are the four important differences amongst the both, amongst all four, right? That is what we are going to see. First of all, they all have the same net income, isn't it? Net income under whichever method you use is the same, correct? Second, equity method. Remember, equity is where you take do you consider the minority stake? Equity and proportionate consolidation. What happens in equity and proportionate consolidation? They both have the same equity. Why? Because in equity also you take the proportion, and in proportionate consolidation you take the proportionate of asset and liability. So automatically the equity value is the same under both the method. But acquisition method will be higher by the amount of minority interest. Acquisition method in fact has highest of everything. Its asset and liability is also higher. Its revenue and expenses are also higher compared to the other two methods. Okay. In fact, in the other two methods, proportionate consolidation is always in between. So acquisition is highest, equity is the lowest, and proportionate consolidation is in between, right? Due to this, what happens to the ratio? For example, net profit margin. Net profit is net profit over sales. Now, net profit under all three is same, isn't it? But where will be the sales amount highest? The sales amount is highest under the acquisition method, isn't it? Correct? And lowest under equity method. So guys, net income is same, but the sales amount is lower. Due to this, what will happen? Net profit margin is higher here and lower here. Understood? Everyone? Clear? Why? Because the sales, wherever, if the sales is higher, which is under acquisition method, net profit margin will be lower. Isn't it? Proportionate consolidation is between both because its revenue is between both. See, proportionate consolidations, revenue and expense, or its asset and liability is between both. So anything regards to asset and liability also, it is in between. Who has highest assets? Again, highest assets are with acquisition method and equity has the lowest. So any ratio related to that, ROA is what? Net profit over total assets or average assets, right? Again, anyone who has highest asset will have lowest ROA. So the treatment of net profit margin and ROA is same. The effect of that is same under all three methods. Equity method will have higher margins and higher ROA. Acquisition method will have lowest ROE and lowest ROA and lowest net profit margin, and proportionate consolidation will be between both. But ROE, in ROE, what happens? ROE is net income over total equity. And total equity is same under equity and proportionate consolidation, but acquisition is higher. So acquisitions ROE will be lowest, and these both will have same ROE and will be higher than acquisition method. Why? Because their equity value is the same. Understood, everyone? Correct. Check this. A company accounts for investment in subsidiary using equity method. Okay. The reported net profit margin is 14%. Analysts adjust the financial and determines that the company's own net profit is 8%, while the subsidiary's profit is 10%. Guys, my profit is 8% and subsidiary is higher. So I'm going to take some proportion of the subsidiary, right? Right. So my net profit margin, when I consolidate, everyone, will be less than 8. Everyone, more than 14. What is 14? Or between 8 and 14? Please tell me, everyone, what will be the answer? Well, if I'm taking over a subsidiary which has a higher profit margin, my profit margin will also increase, right? So it has to be greater than 8, but less than anything that is 14 in this case. So greater than 8 for sure, not more than 14, something that we don't know. Understood, everyone? Correct? The reported net profit margin is 14. We are being asked the net profit margin. It has to be between 8 and 14. Why? Because ours is 8, that is 14. Somewhere between both will be the answer, naturally. Clear? 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 Wow. It's a very lengthy topic. That's the end of your intercorporate investments. Everyone, intercorporate investments and pensions and multinational operations, these are lengthy topics of FSA that generally students are worried about FSA, and that's why we do FSA at the end, because it's got no relation with, not a substantial relation with your original FSA of level 1, right? Everyone, everything that is exam oriented is what we've covered. I would recommend you to only do this and only do the questions that we've done here. If you have extra time, you can do this extra questions, CFA Institute and all of this, right? Correct? Everything covered, right? Any questions or any doubt? Let me know, or I'll see you in the next topic. Yes. Anyone, any questions? Right? Okay.